that we're issuing right now at this very moment. We missed out on massive profits on the first leg down in the stock market. Come to you today more confident than ever with our trading plan and the large returns we can generate in the coming weeks and months. In fact, I'm going to predict we have hit a high in the S&P 500 May 15th in terms of this April rebound. We'll take a look at why. But yeah, that's what's coming down the pipeline. Right here on our screen is the Treasury is about to flood the bond market with more debt than we've ever issued in history. So we'll cover a lot of content today, go through the full trading plan, pile your questions into the chat. I'll answer them as we go, but I do want to get through quite a bit of content so we can put everything into context, get your head screwed on straight. What I don't want to see is people having sold equities towards the bottom on the recent drop in March, seeing this rally, thinking everything's fine as we supposedly reopen the economy, and then only find out that the next big leg down is weeks away. So we'll go through all of this. I'm going to start off by reading the webinar teaser that we sent out today. And I do want to point out every day in your webinar teaser, if you scroll down, you're going to find articles referenced in each daily update. So this has a list of articles I've read in the previous 24-hour period. And I do believe you will enjoy deep diving, as I can only briefly comment on each article during these webinars. We tend to go for 2, 3, 4 hours, and I can barely skim through everything. So let's just start at the top. Massive bond issuance finally announced. It is officially time to get excited. So people must be scratching their heads saying, well, why is the TLT down today with this announcement? Isn't this what you predicted? Absolutely, positively, exactly what's been predicted. So we'll go through the mechanisms of what's going to come down the pipeline here. But this is exactly what we wanted to see. And now we're getting the evidence with the announcements. So remember back in January when this started to unravel, I was saying a huge problem was happening in the economy. Everyone thought we were crazy. We were on new highs. We had just signed a trade deal with China. Boy, did that turn sour quickly, right? So what's happening now? Well, we've gone from a $8 billion plan initially, which I quickly said that's not nearly enough to cover up what's gone wrong in the economy, that it would cost trillions. And now they've officially announced their intentions to sell $3 trillion of debt in the next 3 months. At the same time, quantitative easing is coming to an end. This is an absolute disaster for the stock market and everything we'd want to see in the bond market. And I think one of the best things to focus on here is going to be watching the repo markets. We haven't heard a lot about the repo markets ever since QE came in, so I'll cover that in detail. But just today, you can see the banks are now taking advantage of repo, 20 billion today. I expect this to grow rapidly in the coming weeks. Here's a schedule of what's coming down the pipeline. And again, in the TLT, we now have 2 different bonds. So they did add in that 20-year bond. And if they could figure out the technical issues, they'd be issuing century bonds. So that's going to dramatically increase the assets under management on our 20-year, 30-year TLT product. And that would seem like it's counterintuitive. Now think about it. If you were a normal person and you lost, let's say, half of your working hours, so you're making half the income you used to make, and this is causing you to take on extra debt to make up for the pitfalls in your budget. What do you think the bank should normally do? Increase or decrease your interest rate? Well, in a normal world, the bank would raise your interest rates. By the time this presentation's over, my intentions are to show you proof that the exact opposite will occur due to the way our banks have partnered up with the government and how the Fed manipulates the bond market. So we'll show you this in great detail. I'm more excited about our positions today than I have been in the past month, and that's because we finally have the confirmation that the Treasury is moving the debt out of the T-bills, which were being purchased by the Fed as QE. We have confirmation the Fed is winding down QE, which means they're going to stop buying Treasuries. And instead, the Treasury is rolling that debt into our exact product, the 20-year, 30-year Treasury. So this is going to pull lots of capital out of the markets, and it's all going to be going into this black hole, the US deficit. So we'll go into this in more detail. But again, this is the most important news that's coming out, and it's happening again at the same time. The Fed's going to stop allowing people to sell their treasuries and get cash. Instead, you're going to have to put them into the repo market, which means investors are going to be forced to buy and hold debt coming into this explosion of new debt issuance. So the summary is, this is the moment we've been waiting for, confirmation that the US Treasury will apply extreme pressure to financial markets to fund a massive growth of the US deficit. Yesterday, the Treasury announced $3 trillion in funding needs in the coming 3 months. This is at the exact same time the Fed is winding down QE, which is the only thing that's caused markets to rebound recently. Expect volatility and even drawdown as the largest players, which are central banks, primary dealers, such as JP Morgan, massive hedge funds, think about Ray Dalio, in the know, begin loading up on US Treasuries and are forced to buy and hold due to US Fed QE coming to an end. The repo market is where we'll see the action moving forward. So we'll cover all of this. That's your teaser leading into today's issue. I also want to go through several predictions I think are really critical in tandem with this massive bond issuance. Okay, so this is all going to be coming together at the same time, and I think you'll see this is all designed and planned by the government and the banks to help the government fund this massive, massive deficit. And we'll also look at why they're using the same playbook they've used in every single recession. Okay, so prediction one, president issues massive financial punishment on China within the next 90 days. In fact, I think it could be in the next 30 days. So we have blood on our hands, 65,000 dead Americans. China covered this up. They told the WHO it does not spread person to person. At the same time, they went and bought every possible mask ventilator on the planet. So this will be coming out in a key part of the election. Prediction two. So we did have an announcement from Trump with an interview this weekend where he did clearly lay out what he intends to do with China. He was getting criticism for saying he might default on $1 trillion in debt, but he corrected and said, well, you know, my favorite strategy is tariffs. So think about if we were willing to put on 15 to 25% tariffs on China because they don't buy enough goods and services from the US and because they potentially are competing with us in key markets of the future. What are they going to do to China when they've completely disrupted our economy, caused 30 million people to become unemployed? Every restaurant under the sun, gym, theater, concert, there's so many businesses that are just not going to be able to operate if this is truly as dangerous as I would believe it is. And so we'll cover that. So I expect the tariffs coming down the pipeline to be the tip of the iceberg and to be much more significant than the last series of tariffs. So every time tariffs come in, and again, I would estimate there'll be above 25% tariffs on many, many goods. Okay, so that would be greater than anything we've seen yet. Also, I'd expect to see financial restrictions into investments in China. They don't allow us to audit their companies. More and more companies are coming up as fraudulent, reporting fake revenues. So we really shouldn't have American dollars being funneled into index products. So those are two really important things. And then you create an alliance with Europe to make the same actions. At the same time, we're seeing manufacturing being stripped out of China from Japan to the United States. The bottom line is China has a lot of pain coming its way. So my prediction is that China will react to tariffs by devaluing their currency, that's CNH, the yuan, to offset the president's new tariffs. Okay, so this creates a chain reaction and it makes the dollar strengthen and hits foreign currencies hard. Now, what's the problem with that? Well, we know that a strong dollar causes the stock market to sell off, but why? Well, if you have all your debt denominated in dollars and you do all of your commerce in dollars, a strengthening dollar is a nightmare. Not only are you going to start selling your own currency, potentially printing your own currency to get your hand on dollars, you're going to look at which assets you're less likely to hold to get your hands on even more dollars. So, with unemployment at record levels, with businesses going into bankruptcy, you got to ask yourself, do you feel lucky with stocks or you want to hold on to your treasuries, which pay a guaranteed yield and can go up in value if what's happened in history repeats itself? My prediction is they will be forced to devalue their currency to get their hands on dollars and dump their stocks. Okay, so that's the chain reaction that happens when you get a strong dollar, which I again will believe will be caused by first America placing tariffs on China. China responds by devaluing their currency. All of China's trading partners have to devalue their currency to make everything fair trade-wise with China, and this makes the dollar rise. All the debt in the world's denominated in dollars, so this is a disaster. Prediction 4, stock market crashes, the bond market rallies. Okay, so if I had stuck to my guns in January, February, we could be sitting on much larger profits. I couldn't believe what was happening. Every day we watched this grow at an exponential rate, spread from country to country, watched lockdown hit every economy. And it was just very hard to believe, especially with stocks at all-time highs. People are in a similar state of mind right now with this bounce in April. It was breathtaking to say the least, but it was caused by quantitative easing. I'll also show you that indeed the Fed is rolling down the quantity of QE, and I believe it'll come to a screeching halt here. And the reason why is, again, the Treasury market's not going to deliver profits for the big central banks, the big players loaning money to the government if the Fed keeps doing QE. Not to mention, much of the economy is just not going to be able to get back to where it was in terms of generating revenues and profits. So it's just a matter of time. Okay, also, I do see some notes about people wondering how much money they have to follow the program. Sam, we have a strategy that you can follow in lots of $1,000. We have strategy that you can follow in lots of 30,000. And if you do have a larger portfolio, we have a strategy which most of our members follow with millions of dollars, and it's in lots of 75,000. So we'll take a look at that in a little bit. I just have to bring context to today's trading plan before we go through it, so you have the confidence and foresight to see what's coming down the pipeline here. Prediction 5, as this happens, the Treasury begins selling the $3 trillion deficit at close to 0% interest rates. So remember, all we've done today is announce these issuance. We haven't sold it. So that's what's coming now is we have $3 trillion of deficit to sell into the bond market. Prediction 6, the 30-year Treasury yield plummets towards 0%, earning TLT holders a 30 to 50% return in the next leg down. Prediction number 7, SPY, S&P 500, out of the money, cheap put options return between 500 to 5,000% in 2020. Okay, so those out of the money puts can generate a large return. Prediction number 8, November, December market hits a short-term bounce as hope for a vaccine is hyped and the Fed is forced into negative interest rates. Prediction 9, we have to be careful about naming this fellow by his name, will be censored by big tech powers that be. So Yellow Man wins in a landslide, bashing China connection against his opponent. This is very easy connection to make, and we really have reason to believe that the opponent literally took billions from China, used it to buy out key military technologies in the United States and transfer that technology back to China. That's just the tip of the iceberg. So the heat against China is going to get hot. Prediction 10, the crash is not over by 2020 and goes much lower in 2021 as a vaccine can't be realistically ready by January. That is science fiction. Think about SARS, which has a 76% correlation to this current. That was discovered 17 years ago. And they have not created a vaccine. They made one, they gave it to mice, it created antibodies, great. Waited a few months, gave the mouse the real disease, and it had an autoimmune attack. It died. Okay, so we've had very little luck with fighting viruses with vaccinations. We're really in the dark ages. There's a lot of hype coming out about this, but you really have to be slow. You have to test a small group. You have to see what the results are, what the ramifications of this are. So we'll be really lucky to have a vaccine by the end of 2021. This does lead me to believe that we can have a bounce coming around the end of the year, but there's also a high risk of the economy going in and out of lockdowns. Once we really look at what's happening with the reopening, people are not playing it safe like we saw in China. And again, this can get very ugly if the death count starts ramping right back up, which I do believe it will. Prediction 11, a Great Depression is entered until a vaccine works. And again, I do not think the first vaccines will be proven to work by this new Operation Warp Speed, which is highlighting or promising people a vaccine by January. Prediction 12, crypto, gold, and stocks all crash together as we enter a deflationary period for years. And the key here is if we have deflation, you want to be long bonds. If you have inflation, you want to be long stocks, gold, and cryptocurrencies. So that is something I do believe is going to catch a lot of people really off guard, as these are highly, highly correlated and rarely break paths. Prediction 13, the big gold inflationary run-up doesn't begin for another 2 to 5 years. Now, I do think this can start as soon as we have a working vaccine that has been distributed to the rest of the world. So I'm open to this beginning sooner than later. But again, it really won't happen until we have full employment and all this deflationary pressures have been removed. Sam, no, once again, you can follow the entire strategy with a lot of $1,000 in our buy and hold. So I'll get to that in a little bit. Okay, so that's the big picture of what I see coming down the pipeline. Let me show you our trade alert today to show you how we are positioned. And then we do have a lot of content after that. Okay, so existing members, no portfolio changes today as we stomach more drawdown. Everything we've predicted is coming true. What comes next is the big stock market crash and massive bond market rally as the US Treasury floods the market with bonds. Existing changes to put onto your portfolio today. The next portion of the trade alert is really critical for new members. So if you do not have our portfolio built, you can build the full trading plan today. And I'm going to go ahead and lay out how to do it depending on your capital size. So if you're a new member, here's the full trading plan you can build out today based on multiples of $75,000 following our strategy. All trades are marked buy and hold if we endorse those positions at this moment in time.
Hey, Jason, we lost your audio. Jason, we lost your audio. Hey, Jason, we lost audio.
Okay, sorry about that, guys. We're back.
All right, I can hear you.
Okay, what was the last section you heard audio from?
I could probably just start with the basic portfolio again.
Okay, sorry about the audio drop off, guys. Okay, so if you are following with 75,000, we have a QQQ call option. And whether you have 30,000 or 75,000, we are endorsing the same position size. This will generate a profit if the QQQ trades higher, and it's an upside hedge against our larger strategy. The next position is a put option on the VIX. This generates profit if the market goes flat or up. So this is a position that, again, provides upside hedge and volatility hedge against our very bearish strategy predicting the bigger moves. So again, if you have a $30,000 portfolio, we would endorse a smaller position size of 1/2. If you have lots of $75,000, we're endorsing a 100 share, 100 contract position in the VIX with a 28 strike and the 515 expiration, and then a smaller position on the 32 strike VIX expiring 522, as I do expect us to get near a top as we approach the timeline where we start selling the treasuries. The next set of positions are the higher risk, higher reward trades that are out of the money SPY put options. So in these positions, if you have less than 75,000, I would only take these top 3 positions. If you have a $75,000 portfolio, we endorse the full set of 5 put options. Oscar's wondering what we're going to do with the 5/8 VXX put. Yeah, if we get a bounce between, if we get a sell-off in the VIX between Thursday or Friday, we will try to sell that for whatever we can, Oscar. The other VIX we are going to hold into next week. So this is the first part of the strategy that's really positioning you for the big move ahead in the basic portfolio. If you're a pro member, you also have this exact set of trades. Now, again, if you're an existing member, I will look at our positions that are being held and not sold today, which are always at the bottom of the email. So we will cover that in a moment. If we look at the pro trading strategy, we have a lot more for you to put to work today. So again, in the basic strategy, you have very little of your capital put to work at this moment in time. Essentially, you're hedging against a few more weeks of upside or flat moves in the stock market with the first 2 trades, and you're positioning yourself for the big drop in the stock market with these out of the money puts. Now, at some point in the next several weeks, I do intend to buy an expensive SPY put option that'll likely have a strike around 270. So that'll be very expensive compared to these, and will be the last put option we want to add to our portfolio in the near future. in terms of the SPY ETF. Now, the goal here is to have this positioning and roll into a group of ETFs, which we will cover in a moment, that will benefit from the massive stimulus the government is funding through the Treasury market. And we're going to look at where that money is going to be handed off to from the $2.4 trillion that's been promised so far by the government. And they are quickly growing that figure. Now, if you're a pro member, we can put a lot more of your capital to work today. So this starts off with 200 shares of the TLT ETF, which is about a 44% allocation. We have 400 shares of GDX, which is a relatively large position, although we, again, are predicting a sell-off in gold. So we'll talk about why we have that position today. We have 300 shares in the ETF USO. And again, this is a short-term play. I do expect the government to provide certain types of bailouts for American oil companies in the next several weeks. And again, I will cover exactly what those bailouts are and why it will be very beneficial to USO. And here are the current options related to those positions that we endorse. Now, currently, these are all married puts. So for every 100 shares of each ETF, you now have a put option to protect it. So on the TLT, we're protecting it with a weekly cheap put option. And we have had some profit on that 161 TLT put, not enough to offset your drawdown. But again, we never have a position that can be wiped out from something unpredictable because we constantly have put options protecting the downside. So right now, this is the position I believe is going to rally, and that's why we're buying cheap put options with a weekly time frame so we can chase the TLT higher. Now, I do realize that the TLT has sold off about $7.50 from the recent high. And again, we're not worried about that. The next position is GDX. You have the 821.28 strike put, and this is your downside protection while remaining long GDX. Do anticipate adding a in-the-money put option in the near future to protect our GDX shares and all the profits we've seen in this position. Now, USO is a risky position. If it were to go to zero, we wouldn't care. That's why we have the in-the-money put option with a lot of time premium. I do realize this is by far the riskiest position in the portfolio, and that's why we lock in the largest loss possible by buying an in-the-money put. So if USO did go to zero, while it's currently trading at $20 today, you would get $20 a share because you've purchased that $20 put. The only loss you can potentially realize in this strategy with USO is the cost of your put option. The final position we endorse at this point in time is the put options shorting FXI. So FXI is large cap Chinese firms, excluding Alibaba. It does have Tencent. Mostly it's large banks and construction companies, insurance companies who have a lot of bad debt in the real estate market in China. This has many opportunities, one of which is for it just to sell off with the general stock market, in which I think we can get a very handsome return. But more attractive would be if the US government started to restrict capital flows to China in terms of restricting these ETFs like FXI, or potentially delisting this ETF altogether. So it depends on how heated we get with China before the election and after the election. I do intend to buy a 2-year leap option on this in the near future, so we can take one profit in the next large leg down and then remain long short the Chinese stock market with a much longer put option. So if this did go to zero, we would lose the cost of the put and walk away with $31. So if the cost of the put's below $1, you're looking at a 30-to-1 return. Or in other words, by risking 1% of your portfolio with this put, you can walk away with a total return of 30% in the best case scenario. Total allocation for the basic portfolio is between 5 to 15%, depending if you've bought our SPY put options with your cash on the sideline to jump into our 5 target long ETFs. So what are the sectors that will actually thrive later on this year as the government raises the $2.5 trillion and starts trying to plug the holes in the economy? Well, my prediction is that much of this government stimulus is going to be required to be sent to healthcare sector, the biotech sector, the medical device sector. I believe consumer behavior changes will benefit e-commerce. And then for our best value play, just look at Boeing, the airliners. We've got Buffett dumping his airliners. We've got Boeing have trouble after trouble. So with this group of 5 ETFs, I think we are going to be set up for some very massive returns relative to other stock peers. Now, if you're in the pro strategy, you have much of your capital already put to work. We'll be selling our TLT call options. We'll be selling almost every put option in our portfolio. We'll be getting out of the USO position to free up capital as the opportunity arises so that we can, again, also have that same positioning in healthcare, biotech, medical device, and e-commerce. So that's what's coming down the pipeline. That's how I see it playing out. If you're in an old position, here's what we're currently holding with no action today. So for those of you who got into USO before the split, you are holding either the $4 strike put or the 250. That's a hold. You do not want to be trading USO without your put. And again, the worst case scenario is you just hold to the expiration of the put. Your broker will give you the value of the strike of your put and sell your shares for you. So you just literally hold that until I give you the sell alert for either the put or the ETF. Jay, we got a question from Jay. If USO can go to 0, why would you buy 300 shares? I have 2 accounts which don't have options. Yeah, so Jay, our whole system really relies on using put options to protect your capital. In the pro strategy, you might consider the buy and hold strategy, which only uses inverse ETFs, and that would allow you to easily follow this without having to use options. So I'll be showing that in a moment. Here are the hold but don't buy positions. So we have these 3 TLT call options. Again, I am expecting us to blow past that 180 level. So in the near future, we will sell these calls and move up the strike significantly higher. So I'll be looking at a 175, 180, and 185 set of strikes. So that's what I expect on the TLT front in the near future. We still have a 23 put option open, expiring 5/15, and no trade alert on that yet. If we do get a pullback before then, we'll sell it. Otherwise, it's nearly worthless. The goal again was to have GDX appreciate more than the cost of the put. When we bought the put, we were down around 23. Currently, it's at 33. So we've paid for that put almost tenfold now. And we currently have this dud VIX, this lost. This was expecting Amazon and Apple to have some pretty good earnings last week. They disappointed the market. We had a little sell-off Friday that popped volatility up higher. Now, the volatility index has been going in our favor this week, but not enough for that out of the money put to hit the return we wanted. So keep a lookout for any opportunity to sell that for any quantity tomorrow or Friday, while we remain long the other 2 VIX puts. So that is the trading plan. We're having 7% drawdown thus far in 2020 with the pro strategy, with the bootcamp trades. Keep in mind, almost all of that is in our SPY put options, which have 2 years to pay off. When you're looking for a 500 to 5,000% return, and you're on the verge of an economic collapse, we had to make the decision to jump into that. The day after we originally put that on our portfolio, the Fed came in with $2.5 trillion of QE. Now, people keep asking, are they going to keep doing it? Well, we can look at what they've done, and the trend is actually the opposite, that they are ending QE. At the same time, they're getting ready to flood the bond market. So that's what I'm expecting. And thus, I'm not concerned about the drawdown because these are not realized losses. These are open losses. And we have lots of time for these put options to come back around. So if you're joining a little later in the game, you're getting a much better price into most of our positions. If you followed exactly when I was doing it, we do have some drawdown today, so I'm not trying to hide that. Do want to be quite clear, we're all having this drawdown if you followed the trades. But keep in mind, if we had done this same setup in January or February, when the exact same market sentiment was very bullish that things were going to be great, well, we would be up 30 to 40% right now. So I don't want to make that same mistake here. And if you're a new member just joining, you have beautiful prices to build into this position. The basic membership has the same SPY puts causing drawdown. The buy and hold portfolio has a similar drawdown. And again, its strategy is exactly the same as the Pro. So as we go a little bit lower, here's our buy and hold strategy. So folks like Sam, I would recommend building this portfolio. It's super easy and extremely simple. There's no options. And now while I wouldn't buy this VIX, you can still buy this 28 VIX. Let's go over the buy and hold strategy for account sizes that are below 30,000. So per $1,000 to get the exact same risk to reward strategy that you see in our pro level strategy, you would buy 1 share of the ETF TEX, 1 share of FAS, 2 shares of Yang, 3 shares of the TLT, 5 shares of GDX. You would buy 2 put options on VXX expiring on 5/15 at the 28 strike, and the rest of your portfolio is in cash. So Sam, that right there is your best bet to follow our strategy, and you will have very, very little work to do to optimize that positioning until we have the next big leg down. Okay, so that is a review of the trading plan A to Z. Now I do want to go into some more content here, but if anyone has questions, please post them as we continue. Dara is asking if we're going to take profit on the TLT put. No, because if there's further drawdown on the TLT coming into the big event, I don't want to be riding naked. So I will sell that put tomorrow and then roll it into the next week. So do expect that tomorrow we will sell the put and buy a new put to protect TLT. Okay, so let's look at some more data here. So what's absolutely critical to our predictions is that, well, first of all, we did want to predict that the US government's going to grow its deficit at a fast pace. So we went from $1 trillion deficit last year. This year should be no less than 3 trillion. So check mark in terms of predicting that the deficit would grow. That's exactly what happens every time we have a recession and a bear market. The government comes in, issues massive debt, and tries to plug the holes in the ship, tries to fix the economy, absorb the losses, keep unemployment high. And there's no exception to this case, that when this happens, the bond market rallies and the stock market crashes. So I do not believe this will be different. Sam says, so how does it really work? Sorry, I'm new. I want to know a member. How do I know what to do, when to sell, when to buy? So yeah, Sam, you just follow the trading plan. So every day we hop on this webinar. Every day I review how you should be positioned. And every day I answer your questions live. Now for the buy and hold strategy, I can tell you, you're going to build that portfolio and you're going to sit back and make no changes probably until about November. That's when I think we're going to have a short-term low. Okay, Jay says thoughts on Gilead down. Yeah, so I wouldn't touch stocks right now, Jay. If you want to play a little more of a run up on the stock market, put options on the VIX do well if the market goes flat or up. And that's really what I think is your best way to play that. In general, every stock is correlated and will systematically be sold off. So I just really would not be putting my money on that right now. Okay, Manohar says, I'm new. Why would I buy the TLT stock and also the put? Why not just wait for the TLT to go down and buy then? Yeah, so our strategy is one in which we buy the underlying asset and then we protect it with the put option. So in general, you want the put, the cost of your put option to be less than the profit you've generated each week from holding the TLT. So we like to buy cheap, out of the money put options to protect the asset we believe will be traveling higher. And then in the riskier assets where we're less certain, I'll buy an at the money put with much more time. So it gives me more time for that trade to play out. So it's really critical that indeed you do buy those together. Okay, so that's some recent questions. The next thing we
Yeah, I think we lost audio again, JJ.
So I do want to reduce any confusion as to how deadly this is and help us predict what's going to happen with lockdowns in the near future. Okay, so there's a few camps. There's a group of people who are focusing on antibody tests, looking at data showing that it's been widespread. You can go to certain areas in New York and they'll show 20% have antibodies, but you can go to other counties in New York and there's only 1 to 2% who have it. Okay, you got another group of people, even doctors, who are complaining that what they're seeing is every single mortality must be marked as the virus, regardless of any other condition that the patient had. So they're saying that they're being forced to mark everything as the virus so that they can get compensation from the government. On the other hand, you have people saying that it's being undercounted, that people are passing away everywhere. They're not being counted for. So I was trying to find something that would really put an end to that discussion. And this seems to be the really indisputable evidence. Okay, so we have one group of data from the CDC, and there's a lot of data coming out here. But what I want to point out is that, like clockwork, you can see the deaths tend to spike into January and then pull down into March. And then you get into the summer months and it spikes back up and it comes back down. This has been the case every year for hundreds of years. So what happened this time around? Well, we can see when the deaths should have been dropping like a rock, they shot up far above the January highs to new all-time highs. So this is a worldwide phenomena. Everywhere we've seen these cases. And in this chart, we look at 23 countries in Europe, sorry, 24. And once again, you can see this exact same pattern. Let's go to all ages. So here we go, spike comes back down, spikes, comes back down, spikes, comes back down, spiked, was on track to come back down, and then this pandemic broke out. And so we have evidence to believe that the deaths around the globe are anywhere from 30 to 50% higher than normal over this time period. And if we had not gone into quarantines and lockdowns on a worldwide scale, that this would be continuing to rage higher. So I do believe this is the single most important data that does really show you visually just how dangerous this is. and why the lockdowns were warranted and successful. Okay, so now let's look at our modeling. Now, in our modeling, we're trying to predict one of two things. One of which would be when we could have herd immunity, which means everybody go back to work. We don't have to worry about this anymore. And the other would be trying to predict if when there will be a vaccine that's actually been pushed out to the masses. So those are two things I'm highly interested in, as well as what percentage of the population's already had it. So I have two models that we update daily live. The first one's worldwide, the second is US. So we have 7.5 billion people on the planet. We need 50% to be infected to reach herd immunity. It appears that 9 out of 10 people who are infected will not show any symptoms whatsoever. They're not going to go get tested. They're going to think it's either a mild cold or they won't even know they've had it. Of that group, we're seeing 20% end up needing special medical care, whether that's a ventilator, whether that's special medications. They're going to need special care at a hospital. So that brings us to a target of 75 million people who are going to be hospitalized. Right now, the amount of people who are surviving this that do end up in this critical realm are not surviving. So I have 80% die, which is frightening. This puts our target death estimate without a vaccine and without severe lockdowns at 60 million people. So far, let's give our latest update. We're at 257,000. So this would lead us to believe, and we do understand that mortalities are a lagging indicator. People are getting sick first and then dying potentially 3 to 6 weeks later. So I do understand that. But this would show me that only 0.5% of the deaths have been completed to generate herd immunity. So this does make us really question whether opening up economies will be safe and how much death governments are willing to take to keep the dollars and other currencies rolling and keep their economies alive. Probably the limit will be once their hospital systems become maxed out, you're going to see lockdowns in those specific areas. So another giveaway is, who's super connected? A guy named Warren Buffett. Who's he buddies with? Bill Gates. So the point is that he sold his airline stocks. Buffett hates selling stocks. He's loaded up on treasuries. He didn't buy a single stock during the crash. And in April, with the bounce, he took the opportunity to exit his stock positions in the airliners, which indicates he doesn't believe the economy will be back to normal anytime soon with the inside advice from his buddy Bill Gates. So I have another figure called the antibody risk. So I have this being 10 times off. If I'm off on all this data by a factor of 10 times, then we're still only 4% complete to the path of reaching herd immunity and being able to really open up the economy without the risk of lots of death. Okay, so that's where we're looking at the world data. In the US, we have 350 million population, same exact data. Let's update the deaths today, 72,000. So this puts my estimate at 2.5% of the population has been infected. If we gave that a 10 times incorrect factor, that would get us to 25%. I don't think we're anywhere near 25%. We can go to New York City, where they've been doing extensive antibody tests. The highest reading you can find in the extreme epicenter is 20, but you can go to other counties in New York and find readings in the 1 to 2% range. So I do believe this 2% figure is quite accurate. And what that leads me to believe is we're nowhere near getting our economy back to where it was in 2019, which indicates that the valuation of stocks, which are very, very close to where we were at in 2019, are way off, and that the stock market needs to reevaluate each of these companies. And there's a large shift of wealth. Some sectors are going to do great relative to their peers. Others are going to struggle Just think about restaurants, things of that nature. Okay, so that's looking at the deaths in the US. It's flattening, that's great, but it was achieved with an relatively strict lockdown, although it wasn't nearly as strict as South Korea or China's lockdown. So now we're reopening the economy because we have to, because people are starting to riot, they're going crazy. China, they don't really care what the people want. In the US, people need to get voted into office. So it puts someone like the president in a very awkward position. And again, we're going to go through a few more countries. Italy, extreme lockdown. They flattened their curve, but they're getting ready to open back up. Same with Spain. Same with Germany. Same with the United Kingdom. So my expectation is that they will see their deaths and case counts start to unfortunately grow quickly the longer the lockdowns are removed and the proper social distancing testing strategies are not in place. Japan's starting to show exponential growth again after hiding their data, hoping they could get the Olympics off. Singapore tried to not do severe lockdowns and it hit their migrant labor force. They've had exponential growth of new cases. Anybody hoping the summer would kill this, well, Singapore proves that's not a good idea. 80 to 100-degree temperature, and they cannot get this under control. They have the longest lockdown in effect currently into June. China reported 0 new cases as they opened up Disney today with a lot of propaganda about that. South Korea is flat, but they have extreme precautions. They're actually opening back up everything, but everyone has a mask. You have to have a phone app. There's constant testing happening. We're nowhere near where South Korea is at. The poorer countries can't afford to test, so you're only going to see the wealthiest getting tested in these poorer countries. And as long as we're not willing to lock down all these poorer countries who can't afford to really stop the spread, we're going to have to be very worried of international travel bringing in new cases, which further restricts the flow of commerce and the economy. So we can see India having exponential growth, Indonesia, Pakistan, Nigeria. Russia's really lost control of this. There's doctors supposedly committing suicide, jumping out of windows, who were critiquing the government. And then now Mexico's having a lot of trouble as well. So the poor countries just can't afford lockdowns. They can't afford testing. They just have to let this rage through their society. Okay, so that's a look at what's the underlying cause slowing the economy. I do want to pull up some interesting articles that are linked to in your webinar link with the articles referenced. Okay, so let's start off over here. This is the big headline, which I do believe is going to confuse people, especially with that small pullback in the TLT today. U.S. to borrow a record 4.4 trillion in 2020, more than the previous 5 years combined. And so again, this is happening at the same time quantitative easing is coming to an end and the Treasury's about to ramp up bond issuance, throw in a little geopolitical chaos, and you're going to make the debt for the US near 0%. So again, we're sitting well above a 1% yield on the 30-year currently. And if my prediction's right and yields get driven towards 0, that means there is a 30 to 50% run up in the TLT in the near future. So extremely excited for what's coming down the pipeline in the Treasury market. And I think it's quite easy to predict that, again, stocks, corporations are going to have a rough several years. They're going to make far less than they did in 2019. And so to think that valuations today are valid is quite foolish. Okay, so this is a detailed article It really goes into the details of all the issuance. And again, here they're showing the Fed Treasury purchases, and they have this indicating it's going to go to infinity. But what the Fed's been doing is actually reducing their purchasing and at a rapid pace. So we'll take a look at that data a little later on. But I think the dotted blue line is incorrect, that they will be using repo markets and not QE to force everyone to buy and hold their treasuries rather than to sell them. So big difference in QE versus repo. We're seeing repo start to be used for the first time last week and into this week. And of course, no one's going to use repo when there's free QE. So this is a really neat diagram, but I do believe the blue line is incorrect. And again, they can't force people to buy and hold debt as long as this is happening. Marie says, if testing produces false negatives, is it worthwhile or meaningful? Mustafa says, how much can one expect to make monthly on account size of 75,000? So Murray, yeah, the antibody tests, they seem to have some pretty high accuracy testing going on now at the 98%. There's 2 antibody tests, one of which you develop early on in beating the disease, and a second test, which has less accuracy, that they can pick up weeks after you've had the disease. So yeah, we do want to watch the antibody data, but I'm quite confident we have a very good idea of what percentage of population has had it, which I think is about 2% of the world population. And with the excess death data, I think it's very hard to argue that that the seriousness of the mortality rate has been overstated. In fact, I think it's more dangerous than the media even lets you believe. Mustafa says, how much can we make with an account size of 75,000? Normally, Mustafa, I'm trying to make a boring 1% a month. And that's when, we're not having 30 million people unemployed and the Fed's trying to manipulate the markets. I think we're going to end 2020 well above a 15% return, potentially as high as a 30% return. But we're going to have to be very stubborn and very patient and confident with these positions because as you know, very few people are telling you to do this strategy. They're trying to reassure you into buying stocks. As we know, corporations are not going to be the same anytime soon. So yeah, this is a strategy that's designed for very large returns that are going to be realized in a short period of time when these markets make big moves. So I am confident we can end the year with a 15 to 30% potential return, but it's not going to be a boring year, to say the least. So chaos is coming and our positioning is great for that. Steve says he's got 11% drawdown. When do you think the portfolio will turn? I think we're going to see the portfolio turn when the treasury issuance is laid off into the market. So it's in May 15th and May 20th are the 2 key dates when that begins. And then I also think the punishments on China will help push this market towards our end goal sooner. So I'd say this turns in May or sooner, potentially sooner than those dates, but I would believe no less than by the end of the May, we see the big moves begin. Yeah, you're welcome, Steve. So marketable debt borrowed per fiscal year. And you can see we've been doing anywhere from, I do want to point out, so let's look at time periods where we grow the debt at an exponential rate and just, what happened to stocks during those periods? Well, 2008, 2009, we grew the debt from 100 billion to 800 billion, and in 2009, 1.7 trillion. Okay, so did you have a good stock return when they grew the debt in 2008? No. Now, did you have to be patient? Did the market have dead cat bounces? Yes. Okay. Did the TLT go up 50% in 2008? Sure did. Did the stock market crash 50% in 2008? Yep. All right, well, let's look. What did we do from 2019 to 2020? Well, we've grown the debt from 1.2 trillion to 4.4 trillion so far in 2020. And they aren't even done. Now they're talking about bailing out pensions, bailing out states. If we end up with more lockdowns, we're going to have to get more loans to small business. We're going to have to get more money to unemployment. It's just endless. It's just an absolute disaster for the economy. The only thing that fixes this is getting everybody back to work. And the only way we get everyone back to work is with a vaccine or herd immunity. So there's just no way around it. I wish I could say that we don't need masks. This was a big hoax. It's not dangerous. It's like the flu. But everything I find does indeed lead me to one conclusion and only one conclusion. And that's that the government must bail out the private sector. They must do this by issuing massive debt at a pace we've never seen in history. And this debt issuance alone will make our predictions come true. But remember, that's the egg. The chicken laid the egg. The chicken laid the egg because our economy is just shut off. We've never shut off the economy on purpose ever before in history. And it's not our economy, it's the world economy. So this is coming down the pipeline and we're getting very near. So again, I'm more confident in our strategy than ever before. I realize we have a small amount of drawdown, but again, we're getting very near. So if you go buy stocks today, I really think you're going to be a very, very sad puppy when you watch what happens when the Treasury has to suck $4.3 trillion out of markets in the coming months. Mark says, do we have to stomach the ride or are we at risk of any margin call? No, we're absolutely not at any risk of anything of that nature. Sorry guys, I bought this super fancy headset that turns off if it doesn't think the audio is pouring. I'll get this fixed by tomorrow. You can hear me now?
Sounds good.
Okay. Yeah, my apologies. Go pay a couple $100 for a fancy headset and it turns off on you automatically. How comical is that? Okay, so that's the big picture is the debt is exploding. Now, again, the reason the debt's exploding is because the economy is crushed. They don't just go print massive stimulus and hand out big bailouts to all their donors. In normal circumstances, they only get away with, in the past 2 years, $1 trillion deficit per year. To see this print is absolutely insane. And again, the reason they're doing this is because the economy is broken. You have 30 million Americans unemployed. You got food lines going miles and miles. It's really bad. The stock market's up. That should be a crime. It's happened because the Fed had to bail out the treasury market, and that created a lot of liquidity. Mustafa says, what broker? I like TD Ameritrade. You can do everything we need at TD Ameritrade. Okay, so that's the most important data that you need to track. Here's a detailed schedule. You have links to all of this for the next quarter and how they're going to come up with $787 billion in the next 3 months. And again, that's just the start. This is, they have several quarters, and this is just suggested recommendation. So massive, massive bonds are going to be sold. These are going to be purchased by central banks, by primary dealers like JP Morgan, by huge hedge funds like Buffett, like Ray Dalio. Okay, every big player buys these and they know why. It's not for the yield. It's because if the yield goes lower, then the value of the bond goes up. And if you think JP Morgan and Goldman Sachs are going to take a huge loss loaning the government $4 trillion, I've got news for you. There's no way in God's green earth that the biggest banks in the world who control the Fed are going to lose money with their partnership with the government to loan them $4 trillion. It's absolutely insanity. There's no way they lose on this. And again, it's because the Fed manipulates the bond market. Jack says, why is the TLT down today? Yeah, so it's still an asset that's bought and sold, so there's supply and demand. And really, Jack, it's when the bonds are actually being issued that we're going to put the stress on the market. So those will begin being issued on this time frame. So we looked at that, but I'll pull up that chart. But yeah, the big bond issuance begins in mid-May. So that's when we're going to see the market really start to have pressure from the bond issuance. Okay, D says, will stocks go down if the Fed start buying? So they're going to buy bond ETFs and they're not going to buy stocks. And that's going to happen mid-May as well. So they're protecting, again, the banks, and they're not protecting retailers. So if they were to buy the SPY, that would be one thing. But to buy LQD, that really just helps these corporations remain solvent and keep some level of employment. So they could turn around and do some stock buybacks, but when you have a $30 trillion stock market, there's just not enough bond issuance available to protect that level of evaluation. So yeah, I think you're going to see, and I have a slide about that. We'll take a look. But again, they're not buying stocks and they won't buy stocks. That's not the game plan. And that's not what the Fed does. They protect the banks. The banks are in the business of credit and debt. So they protecting bond markets. Okay, so we have a April jobs report likely to show the highest unemployment rate on record. Remember, the US economy is 70% based on the consumer. So if you lay off 20 to 30% of the consumer economy, how can you possibly predict the stock market's going to do well? It's absolutely asinine. And again, the Fed has been buying treasuries to protect the credit market, and that's expanded its balance sheet, but that's coming to an end. We've watched that dramatically reduce, and perfectly in time with when they start to sell the big debt issuance. So they haven't sold any of this $2.5 trillion we recently promised, and they keep racking up their promises. So we haven't even stopped making promises from the government with what we're going to bail out. It gets bigger by the week. Okay, so here is the bonds that, this is US aggregate corporate bond yields shrank from 3.7 down to 2 the day the Fed announced they're going to buy corporate bonds. So there's some people trying to play this. I'm not so sure if this will go any further, but they may just keep the junk bond and the investment grade bond market liquid. I don't think I would expect it to go much lower, but I think it can stay flat. So if you like those products just for their yield, probably a good opportunity there. I'm a little skeptical that these products will go much higher, and we'll take a look at that, especially when we look at the correlation of corporate bonds versus the TLT and corporate bonds versus the stock market. TLT, I believe, will go up for several years too, based on how long it takes to sell the massive deficits the government's creating. So the playbook is the big banks are going to lend money to the government, and the government's going to go fix the economy by bailing out various parts of the private sector. And then after that, after the economy is fixed, corporations are getting back to work, people are unemployed. Once they think it's safe, they say, okay, we're going to do quantitative easing now. And that's where the big banks can go sell these debt products to the Fed with no risk of ruining the credit markets. And they get a huge profit, and then they buy stocks. And that's what's actually going to cause the bottom in the stock crash, is when the Fed pumps QE back on and allows these big bankers to exit their bond positions. So again, the Fed's not buying stocks, they're supporting credit markets, which protects banks. Banks are in the business of loaning money, and so that's what their main concern is. Remember, the Federal Reserve is governed and controlled by the big banks. They're not a government agency. Okay, German factory orders declined 15% in March. We're just going to have slide after slide for the next 6 months of how bad the economy is. Okay, a lot of people are getting hyped up on the cost of mining cryptocurrency is about to double. So for some odd reason, people think that's bullish just by looking at this. What I want to point out is uh, really two things. Number one, by and far, the entire run-up of Bitcoin's life was one of which there was quantitative easing and low interest rates. And in fact, the only time that we've ever had any sort of deflationary pressure, which was when 2018, when we started to hike interest rates and we started to do quantitative tightening, cryptos crashed from 20,000 to 4,000. Horrifying loss. So now everybody's predicting this is about to pop to something like 200,000. I don't think that is going to happen. In fact, I'm looking at Bitcoin and Ethereum as my best leading indicator to give me a heads up for when the big crash is ahead. So I would expect no less than by the end of May that you will see a 10 to 20% move down in these two assets in a single day. And that'll really be the heads up that the big players are starting to move money. So really the correlation is that there's inflationary products, there's deflationary products. Okay, Bitcoin's an inflationary product. So that means you need full employment, you need too much money circulating, too much pressure on uh, buying pressure, driving prices higher. Okay, so that's just not in the cards anytime soon. Okay, people are saving money, they've lost their job, they're scared. So this is more like the 1929 Great Depression than the 1970 runaway inflation that we're walking into. So I think the short-term QE was again just to protect the credit markets. And now that that has been resolved, I do not predict QE at the levels we saw in March anytime soon. In fact, their trend has been to drop that down, which forces people to buy and hold debt, which is the game plan. The game plan is loan the government $4 trillion, bail out the economy, get people back to work, and then we can allow people to sell that debt, which is again, mainly JP Morgan and other foreign central banks. So beware, this quite likely will end very poorly for someone who's overinvested in this asset, believing the hype. And so I would look for opportunity to buy it at a steep discount, as I do like Bitcoin, just not until we again have inflationary pressures, not deflationary pressures. Here's a look at our imports and exports. So if we were hoping our deal with China was going well, you'd expect our exports to not be falling off a cliff. I do expect the government to be bashing China for not living up to its phase one trade deal. Interesting enough, China threw in a act of God or pandemic clause that lets them off the hook. And funny enough, they signed this in December. They knew about their problem in November. Interesting. So this is good indication that the phase one trade deal is not being met, not even close, and also shows the general health of the economy is plummeting, which is again why you want to be long bonds, short stocks. Who's going to open up their economy? Who's going to be shut down first? I bet you by November, December, a lot of these are going from opening to back to lockdown because this is a very deadly disease. It spreads rampantly. And now we're starting to see children have to get hospitalized in New York City. So that's really, really sad news. And again, imagine you go send all the kids back to school, and now you have thousands of kids with these oddball health problems that are putting them on ventilators. So scary times ahead. We did not do a proper lockdown. We do not have the massive testing available. So this is an absolute, just complete catastrophe. Um, so I don't see how the current president wins the election based on his saving everybody from the virus. One, two, I know that most of his base crowd does not want to be locked down. They think this is a hoax. and that they're losing their civil liberties, that the risk should be something that individuals have to make a choice, and that shouldn't be forced upon them. We've got stories of people who are doing vitamin C treatments being rated by the Fed. There's another guy who's been out there selling colloidal silver. Fed's locked down his whole website and took all his inventory. We're seeing a lot of attacks on hydroxychloroquine. So definitely the pharmaceutical industry wants to make a huge payday on this. I'm trying to make heads or tails out of who's on what team, but clearly we have people who do not want to break up the relationship with China. They're printing money with the cheap labor, so they're more interested in a globalized economy and multi globalized corporations. Whereas you have another faction that's much more interested in bringing manufacturing home. So there's two clear, powerful parties fighting over control. It's going to be a bloodbath going into the election. I believe that the current president's going to bash the competitor and mainly about China. So I do expect China to be the headline for the next several months as we lead into the election and for this to get quite ugly. This was an interesting video that's in your guide, your reference guide today. So I do listen to lots of opinions on this. I like to have those who call this a pandemic. I like to listen to those who think that this is not as nearly as deadly. It's like the flu. I've got folks who are focusing on antibody data, trying to prove that, we pulled the fire alarm too late. We already burnt down the house. This fellow is definitely in the bearish camp on the virus, but I would say he's got pretty darn good information. In this video, if you really want a detailed analysis of why this does not look like a natural thing in nature, okay, we know it's novel. We've never seen anything like it. This goes into really deep analysis of how it works, why it works, through all the relatives, all the viruses we've collected, what's related, what's not. And I think if you go through this, you'll really understand that right here, this area right here, SARS-CoV-2 has a 0.6 furin score. This is the enzyme that allows the protein spike to actually make the RNA go into the cell and infect. So without this huge amount of furin, it's not nearly as contagious. So we can look at the viruses in the past that were similar. There's bat cov with a 97% correlation to SARS-CoV-2. And then we can go to the original SARS, which was from the camel at 76%. So those two have the most in common with this. But what they have is a super low furin score, which is the enzyme that allows this whole process to take place. So you go down the family tree and you can find plenty of these nasty viruses that do have that high level. So you got to watch the full video. This is also really interesting. It's something like a family tree of these in terms of how they're connected, what's the timeline. And so here's SARS-CoV-2 in pink with the high level of the furin. And you have to go way across the spectrum to find other viruses that have that feature. So there's an article in Nature magazine saying there's no way this was man-made. It must be natural. And people have gone back and looked at some of the links that they pulled out of their original article, which go through test after test after test that proves that we can do all the things that we're seeing new in this novel SARS-CoV-2. So great video. Highly recommend you watch it. And I think you'll find that most likely we were manipulating this. And unfortunately, the US certainly has ties to that exact laboratory. So I think there's some very interesting things that'll come to light with that. But in general, this is extremely dangerous, and all of the lockdowns have been highly warranted. And I think we will have to see those in the near future if we really open up the economy without the right precautions, which does seem to be what's happening. Okay, this is where I live, New Mexico. The governor quarantined an entire city, mostly Native Americans, Apparently, it's a bloodbath. These folks, from my just personal encounters, don't believe in vaccines. They don't believe in viruses. They don't really believe in a whole lot. So this population has been ignoring all of the recommendations, and now they are massively infected to the point that we have a China-style quarantine locking down all of Gallup. So just goes to show what happens when you ignore the precautions. It is deadly. Russia adds a record 10,000 cases. Just interesting, just very sad. This is a Texas park ranger who's trying to tell people in Austin to stay away. And so you can see he's out here trying to explain to everybody need to spread out. The kids just do not care. They're here to have fun. And the poor guy gets pushed into the pool, or rather into the river. After 6 weeks of lockdowns, Miamians enjoy their first weekend of reopened parks. So again, people are going stir crazy. I think in the next 30 to 60 days, everyone's going to stop wearing their masks for the most part. And again, this is going to be just absolutely spreading like wildfire going into the election. So that's unfortunately where we're at. Do you want to die of starvation or you want to die of a nasty virus? Who's to say what's worse? Mysterious coronavirus linked syndrome spreads from London to New York. So we've got 15 children in New York City that are hospitalized with unusual symptoms. 4 have tested positive, while 6 had antibodies. So again, if we start to see lots of children getting sick, you're going to see the whole world go into lockdown right out of the bat. This is a good article that you can read into, again, in your reference link. Whistleblower failed to prepare, sought quick fix. There does seem to be, I believe, hydroxychloroquine, from what I've come to find, probably the single best strategy we have. Okay, so sorry about the audio, guys. This article is about a whistleblower who would not endorse hydroxychloroquine. And again, there's a lot of negative information being pushed on hydroxychloroquine. And I think that's to benefit the big pharmaceutical company. So remdesivir costs $1,000. The data would show you'd need to treat 30 people with it to save 1 life. And that's really a stretch. So 30 grand per life saved. The strategy I believe that would actually work here is massive, massive testing. So you test every child going to school 3 times a week. The second you find anyone with the virus, you send them to stay at home. You give the whole family a dose of this with zinc. And I think you would really be able to control the spread and keep the economy rolling and bring faith to the population that it is safe to go out. Still have to wear your mask again until we get a vaccine. The same thing would be true of the commercial sector. So we need to be able to pick up who has it the second they get it and immediately give them the right medications to help their immune system fight it off quickly. So that's not what we're doing yet. There's a group of scientists who've been giving the government advice, but for whatever reason, they have chose to ignore that advice at this point. They're reopening the economy. We don't have the testing. Now, I did see Trump pitch hydroxychloroquine this weekend, so I do like that versus, again, just funneling trillions of dollars into pharmaceutical companies with stuff that's not tested. And again, the testing on that continues to get stopped. Dallas Salon owner jailed for reopening in violation of a court order. So she was making people wait, had all the safety precautions, but broke the guidelines. Now she gets to spend 7 days in jail. And again, there's 250 people infected in that jail, so could potentially turn into a death sentence to end up in a jail cell right now. But just goes to show you the tough situation the current president's in. Is people want to get back to work. They are pissed about losing their civil liberties. But on the other hand, it's clearly a very deadly thing hitting our economy. Here we are in
France.
France. Yeah, that's where in France. So France came out with this little greenhouse. You can see the people wear the face mask. They got the gloves, and you get to go stay in your little glass house for your lunch. Again, is this economical? What's the cost of a dinner when you have to reduce the restaurant's capacity 20, to 25% of normal business? We got Murray on here. He's been a restaurant owner. It's tough to make money even when your restaurant's slammed to the brim. This just won't work. So there's just so many different small businesses that are going to be eaten alive until we can safely enjoy company of one another. Unfortunately, my analysis, as much as I hate, I'll go out to Home Depot with the damn mask on, could barely breathe, and you really got to ask yourself, is this crazy? Do I really need this? And so, so Pat says there are several international clinical studies showing the hydroxychloroquine causing heart issues. So I call BS on that. This drug's been around for decades. It's well known what the risks are. So yeah, if you go do 100 times the amount, absolutely you're gonna give yourself a heart attack. But doctors know how to use this medicine safely, and if we were giving it to people early on, if we could predict who has it extremely early, isolate that group of people, everyone they've been around, and get them all loaded up on this, I guarantee you it's a much better strategy than what we're doing right now. So what are we doing right now? Right now, you have to beg to get a test, and it's only going to be achieved if you're either really sick and on the verge of dying, or if you have a huge checklist of symptoms that makes them think the test will come out positive. So we're not doing the right testing to give confidence to allow the economy to open up and get commerce back to normal. Now, it could be achieved with what we have outlined. And again, I didn't come up with that. A huge group of excellent scientists came up with that strategy. I read it. It was 18 pages. It was a good strategy. It would work. We're not using it or anything of even close. So there's a lot of small businesses that are not going to be back to normal anytime soon. And meanwhile, we don't have enough masks even for our healthcare sector, much less the whole population. So finally, they're getting this rolling out. So there's an article on that. There's also a lot of people mysteriously dying connected to this. So 2 Russian doctors dead, 1 in ICU. They were all critiquing the government, complaining about conditions and lack of protective gear. So there's an article for you on that just hit today. Now they took this back, but there's a headline out that the White House was going to wind down the task force, which again would be a disaster, but they said that's not true later on. And another strategy being employed all over are thermal cameras. Problem is the data is showing, even in the hospital setting, less than half of the people who are known to be infected don't show a fever. And you can also hide a fever with acetaminophen. So not sure that will really work. Really, we just need massive testing constantly. Okay, so now we're looking at the Twitter headlines that we've highlighted. And we have 90 live. Very good, guys. Thanks for listening in. And we've got some more content. We'll take a break in a few moments to review our different products for those of you interested in joining. But let me get through the topical news and we'll take a break and let Dean review our products once again. And then after that, we'll go into extensive question and answer as I also get through a lot more data. We haven't even touched the charts and the economic data yet, guys. We have a lot more content to get through here. Okay, so 10-year yield spiked. I want to point out that in 2019, we had a great economy, and the only thing going against it was the Fed. The Fed was threatening to hike rates and to do quantitative tightening. And this led the 10-year Treasury to go to a 3% yield, which is really high, I admit, compared to this current 0.7. But that in itself caused the stock market to crash for the final quarter of 2019. You remember that Christmas massacre? So the worst thing that could possibly happen to us is the yields on our bonds spike temporarily, and that in itself will cause a flood of money to ditch stocks and buy up the attractive bonds. So again, I'm not concerned about any drawdown on the TLT when we look at the big picture. Ram asks, are the VIX good for the next 2 weeks? Yeah, the first VIX that expired Friday, I was hoping to get us a huge return playing the Amazon earnings. And so I thought Amazon was going to come out with blowout earnings and just really push the market much higher, maybe push the SPY towards 300. And unfortunately, they came out and said the pandemic is creating chaos in their ability to really operate, and that they're going to have to set aside billions of dollars. In fact, they're having people protesting, not wanting to work, saying it's unfair conditions, that they become billionaires while these guys make 15 bucks an hour. So even Amazon's having trouble in these conditions, which did catch me off guard. So that was an Amazon play. But as you've seen, the market rallied right back up. We still have some QE. This Friday, I do expect that they will continue to reduce that. So we went from 10 billion a day down to 8 billion a day, which is still a lot of money. $40 billion of liquidity being added to banks just from treasuries. We'll see what they've done in the mortgage-backed securities. And they're also giving swap lines to foreign central banks to basically have access to dollars so they don't have to liquidate their own currency or stocks or treasuries. So that's coming to an end. And again, the reason why is they have to force these guys to hold the debt. We got to raise all the debt, trillions and it's probably going to be close to 10 trillion of deficits between 2020 and 2021. Everybody has to be forced to buy and hold that debt so they can keep selling it. The government takes that money, fixes the economy. After it's fixed, after people are getting back to work, really the key is herd immunity or a vaccine. Then they do the next round of QE. So don't be shocked when the QE stops and all of a sudden there's no reason to bet on a stock market when you know corporations are hurting and not thriving like they were in the last several years. In fact, they're going to be doing the exact opposite. Elon Musk officially qualifies for his $700 million payday. Oh boy. This guy's got a really cool visual here. And so support and resistance, what you're seeing in the red heat graph here, this is looking at options. So you can see this is exactly why I like the VIX trade. This means we could be stuck in this range until it catalysts, and that will make the volatility index go lower. So I do really like our VIX plays. The disappointment with Amazon is the reason we lost on the first VIX, but the VIX is traveling lower, and I do think we can get a nice return on the remaining two we have long. So that is still a position. And again, I do anticipate selling those either next week or the week after. So I'll get more exact timing on that. But yes, I do believe we're getting towards the end of the low volatility QE realm, and that we're now going to switch gears and focus on trying to sell this debt to foreigners. And again, that'll quite likely coincide with a lot of pressure on China. Government knows the strategy to sell debt is to wreck other markets. I love listening to Nomura, and he's quite accurate at short-term predictions. He was warning of a dead cat bounce on this rally, and now he's becoming bearish. So you can go read his full article. It's not linked in today's article. It will be tomorrow. Essentially predicting that by mid-May we hit a top. And he's also focusing on this huge debt issuance that's going to really suffocate the market's liquidity. quick thread on central bank liquidity swaps and global dollar liquidity. Since the great financial crisis, there have been 3 periods of major swap line usage, 2008, 12, and 20. Okay, so we can see last time we had a spike like this. Again, it was in 2008 crisis, so not good for stocks. Default promises kept. I will eliminate the US debt in 8 years. Oh boy. So, ouch. Yeah, that's not happening, is it? Fed accepts 20 billion in repo. Again, this had been zero during QE. So repo is really good for treasuries. Essentially, somebody like JP Morgan can borrow from the Fed for free, buy a treasury with a positive yield, making a profit. Then they can go hand it off to the repo to hold safely for them. The Fed holds that and gives them cash, and then they can go lend that cash out and make even more money. So repo is great for the bond market, and it's great for the primary dealers who have to buy the US Treasury debts. They don't have a choice. So expect this to ramp up higher as we start to really pound the market with trillions in debt. Here's the coming issuance in the next few weeks, $96 billion, 42 at the 3-year, 32 at the 10, 20 billion at the 20-year, and 22 billion at the 30-year. So that's coming down the pipeline. And again, the 20-year is now added back. That had been discontinued for about 3 decades. They put it back in. That is part of the TLT. If they can figure out how to program the 100-year, they'll probably add that in too. So the TLT will be extremely leveraged from that. ADP data shows companies slashed over 20 million jobs in April. So come on, do you really think the stock market's going to do well with 20 million people unemployed? Is that going to force people to liquidate stocks just to stay afloat? Yeah, it's a bad period of time we're coming in. White House expects a 40% decline in US GDP in Q2 and a rebound in Q3. So why are they reopening the economy when they know how deadly this is? Because they don't have a choice. They have to get reelected. Half the population's furious, and the other half is going to go broke. So hopefully they roll out some extreme testing, mandatory masks, and take the precautions that were recommended by that scientists against the virus group, which has PhDs from Harvard to MIT to up and down. They have no affiliation supposedly with these pharmaceuticals, and I do indeed like their plan. So I'll try to include that link again tomorrow for those that want to reread that. Clarita says unemployment rate is going to surge to levels not seen since 1940. Airbnb to lay off 1,900 employees. So think about the two, using that as collateral to buy a second home. Then they have 2 houses. Now they could go buy 4. All of a sudden now you have 4 houses. You got collateral to buy 8. So stupid, right? That caused a 50% crash in the stock market, and it's tiny compared to the problems we have today. So people in Airbnb have been doing the same strategy, but now they have a extremely leveraged income source. Instead of making, say, $1,000 a month of rental income, with the ultra high prices you can get off of Airbnb, you can be making 2 to 3 times what you would have normally made. So these people were making huge investments, leveraging their properties, buying up as much as they could get their hands on. And now people are scared to travel, and their mortgage costs, some of these people have mortgage costs of 10, 20, 30 grand a month, and they have 0 income. So think about the mass liquidations in the real estate market just from this single company. Then add it to it that most restaurants will fail, most bars will fail, concert venues are in trouble, malls are in just anything where you have a public crowd is going to have less traffic flow to be safe. So real estate industry has some serious problems coming down the pipeline. Okay, some Chinese propaganda here. Shanghai Disney will reopen next Monday, becoming the first Disney theme park to resume operation worldwide. Disney is telling the world where the epidemic control result is the best. and where the conditions are ready for reopening. So we've seen them just talk trash daily here. So we're seeing the rhetoric ramp up here on both sides. One of the guys I like to really listen to is in Philadelphia, JC on the bike, who's a biologist. So be curious if he's um, startled by this. This fellow was on the cusp of a COVID-19 breakthrough and killed in a bizarre murder-suicide. So the guy who killed him was found dead in a car a few feet further down the road, as though he killed this fellow and then went and killed himself. Interesting. I have only read the initial report, but again, just today alone, we have 3 people who have been murdered related to doctors or people studying this. Also, we saw the Fed again taking down people trying to sell colloidal silver. We had a therapy center trying the vitamin C treatment that was shut down. So really, the only options super expensive pharmaceutical products, and of course, there's obviously a bias to that. Okay, spot gamma showing your support resistance levels. Again, we've got support at 286, resistance at 290. I thought Amazon was going to push us above that range for a big win last week on the VIX trade, but there's still enough QE happening that I still like our VIX positioning. But again, I do think we're getting near the end of the rope for this QE based rally. We ask for help, but it never comes. Dead or left to rot, then buried in mass graves in Brazil. Chinese buyers flee Hong Kong real estate in major hit to the world's priciest property market. Square footage on this is in the $20,000 per foot range in Hong Kong. This was the key financial center for China, but now they're moving that financial center to Shanghai. Next move I see US doing is revoking its special status, hindering capital to Hong Kong from US and its allies. And this is an absolute disaster for Hong Kong. So interesting. I was really diving into this trade with the Ameritrade folks yesterday. We have a really exciting trade for bootcamp members shorting the Hong Kong currency. The big story is that they have $1.4 trillion worth of their currency in USD. So that's, you have to multiply that by the exchange rate. But they only have $400 billion in reserves. So what would happen if people start selling real estate and becoming concerned about their currency? So that could cause a run on the Hong Kong banking system and essentially bankrupt their currency. So with our trade, we're short. I'm going to cover this in great detail on the Thursday bootcamp once again, as well as reveal some new economic slides. But I do want to point out that this trade is getting better by the moment. And so my big question yesterday to Ameritrade was, well, if this were to turn out as we hope, which is again, essentially their currency goes to a value of near zero, what happens when the counterparty has a margin call? And so it would actually be the broker dealer who would have to take on the risk after that, because this is our potential 100-to-1 returning trade with very, very little risk. In the last 2 decades, the biggest change of price in the Hong Kong dollar against the US dollar was a move of 1%. So if you have $1,100 per mini contract, plus capital for your swap cost, this is my most exciting trade. You have very little risk to lose money, extremely little. Again, the biggest move in the last several decades was a 1% move. And that's because it's designed to track the dollar. So the big bet is essentially China ditches Hong Kong. They can't afford to protect the currency, and the currency goes to a value of zero. And that's how we can get a 100-to-1 return. I do intend to increase our positioning the second we have official tariffs announced by Trump. with every spare penny, really, for our boot campers, we want to put in this trade because you have almost no risk, and that's up to 3 to 5% that we'd be willing to put in this. Right now, we have 1%. So a 1% position, you can almost never lose money. The biggest volatility in a decade was 1%. The mechanism for us to lose money on this trade would essentially bankrupt China and Hong Kong, because everybody would take the deal if they strengthen that currency. And the potential is 100-to-1 return if Hong Kong goes under. So it's a huge trading opportunity. Kyle Bass has been making this famous for a couple of years. All the stars are aligning. I've been sitting on issuing this trade for over a year. We just issued this a couple weeks ago. Right now we have 1% in this trade. And again, I will go into great detail on this trade Thursday, because you can double your net worth with 1% placed in this trade. So we'll keep going, but that is getting better by the moment. The one primary thing the United States must do is require all foreign security registrants to adhere to U.S. security law, like U.S. companies do. They need to submit to U.S. audits, and Chinese investors need to pay U.S. capital gains. So the big complaint is that Chinese companies don't let us audit their earnings. So there's been a lot of companies found to be making up numbers in billions of fake sales. So if we were auditing them, that wouldn't happen. So why does a US company have to have higher standards than Chinese companies? And why are we funneling the pension funds of the government into Chinese ETFs when they're really our greatest threat? So it makes no sense. We've got lots of people in the government who are raising these concerns and trying to pass laws in this effect. So I do think this is going to be on top of tariffs. And again, is very good for our FXI put, and also very good for the Hong Kong trade. While Brits are on lockdown, 100,000 people from abroad arrive at airports every week. So the spread's not going to be stopping. I'm going to stop with this one. Reopening the economy prematurely will definitely lead to more deaths in the US. Trump team is betting the worst death toll peak will appear after November 3rd. They're taking advantage of the fact that the American public has accepted the daily death toll of over 1,000. Cold-blooded. Ouch. And Stephen Heinrich, this is absolutely correct. The market is entirely dependent on 5 stocks not selling off and to keep adding to their multiple expansion program. Every time we get extreme consolidation of capital in a handful of stocks, it has marked the top of a bubble. Okay, let's take a break and go into our pricing for our different products, what makes sense for which investors, what our bonuses are to join today. And I do have more content, so stay around after this. I'll be taking a quick break and coming right back while Dean fills you guys in on the details of this.
Chat box. Okay, folks, thank you for that, Jason. Appreciate it. If you look in your chat box, there is a link in there, okay, that will take you to this page, okay? And when you see that little pop-up that just appeared, that will allow you to communicate directly with me, okay? So just feel free to ask a question if you have one there. That will take you directly to my computer screen, okay? So Jason, if you want to go ahead and minimize that, we'll kind of go over the programs here. But at the bottom, guys, we have access to our boot camp. Okay, this is going to be where we take you from any level of trading you're at, your experience, to a professional investor. Okay, I'm going to walk you through how the financial system works, how the central banks have absolutely controlled, derived, and influenced price action in the bond market, stock market, and gold market in the past 92 years of the U.S. stock market history. Okay. And really teach you about options inside and out, forward, backward, sideways, upside down. Okay. And it will literally, the design of this program is to take you from any level of trading that you're at now to a pro level. Okay. And the really cool bonus that comes along with that is you get a free year access to our pro portfolio Okay. And it's really cool. You're going to be in the boot camp for life. It's going to take probably years to go through all the modules, right, to get all the education. But it's really cool. You will have lifetime access to that to really take your trading to the next level. Okay. Next is going to be the Pro Portfolio. Okay. That is going to show you how to basically take your capital, folks, and trade it like a hedge fund manager. Okay. You're going to really understand how to be long or short the 3 asset classes that matter. Okay. Bonds, stocks, and gold. All right. And our models are currently showing us to own bonds. Okay. To own gold specifically, it's better to own gold miners right now. Okay. And to be short stocks. Okay. And it takes at least 75K to build the Pro Portfolio. But most of our clients have tranches of 100,000s and really kind of, I think our biggest client has a little over $4 million behind the Pro Portfolio. Okay. But as long as you have 75K, you can build it and follow it. Now, next is the basic option. And that's going to be really good if you have between 30 and 75K in capital. Okay. So if you don't have quite enough to get up to the Pro level, okay, the basic option is phenomenal. And we're going to show you how to utilize options for now to take advantage of the situation. And then eventually we will get you back into the market when the blood is officially flooded onto the streets. And when that happens, it's time to feast. We're not even close to that level yet. But we will tell you when that is the time to go get back into stocks. Okay. And last but not least is a buy and hold portfolio. Okay. If you have less than 30,000, this is your option to basically profit from safe transactions in the market. And just really quick too, folks, when you do get the basic or the Pro Portfolio, you will get access to the boot camp for 30 days to get more, just really increase your education. Okay. And then if you want to add the boot camp later on down the road, which many of our clients do, we can always do that as well, but we give you 30 days of access for free. So if you really don't have any experience whatsoever and you need help getting into the markets, the boot camp's great for you. Okay. And even if you're, kind of a decent level of, understanding of the markets, this is going to take you from the level you're at now to a really advanced level of investment. Okay. And we look forward to helping you folks. If you have any questions, go ahead and feel free to chat with me in the chat box there, or just give me a call from the number in the top right corner of your screen. Be happy to help you with any questions you may have. Look forward to the honor of helping you and your family, or you and your family grow your portfolio, expand your wealth, expand your foundation in these crazy new times. So thank you very much for your time, folks. We appreciate it. And the link is in the chat box now. So go ahead and just click on that link. That'll take you to this page, and then you can select what option works best for you depending on how much capital you have. So thank you very much for your time, folks. Truly appreciate it.
Excellent. Very good, Dean. Thank you so much. We have more content, and we still have 80 live. So great job sticking in here and learning a lot. Let's see. What questions do we have? Mustafa says, are the prices annually or one time? That is the annual rate, Mustafa, although a lot of our clients do, they go arm wrestle Dean into a lifetime deal after they're really confident and really want to commit to us. So as you can see, Mustafa, with my job, we have to show up and tell you what's going on, whether it's good, bad, or ugly. So there's been periods where we're making money hand over fist. There's been times where we have drawdown. So we have to show up and discuss what's going on in the portfolio. We have to be honest about mistakes we've made, how we're going to change our mistakes in the future. And we have to be open-minded. So that's what's really neat about our group. And even when we have no trades, like for example, today, the trade alert said, nothing to do, guys. You are fully positioned. My predictions are coming true. We have drawdown, but everything I've been predicting is coming true. Make no changes. Guess what? The whole crew shows up every day because of the content and education we provide daily. So we have a great, really excellent group of people who follow this. And so yeah, you can buy annually. You can buy a lifetime deal after you get really confident. And you can also upgrade. So a lot of people start off small and work their way up to the more expensive programs. So those are the options there. Okay, let's jump back into some more content. So I know we usually take a break at an hour mark. We went about 2 hours and kept the entire audience. So again, thanks for listening. And we still have a lot more content. In fact, we haven't looked at a single stock chart yet, have we? Okay, so I'm gonna go ahead and take a break from news in general. Our prediction is that opening up the economy is necessary for the president because his base does not want to be locked down. So can understand why he's doing that. The problem is it's going to be a disaster, and I do expect to see case count start to skyrocket. I'll hope that they can get massive testing, and again, some of those precautions we discussed that I do think would help get the economy at least to some level of operation. Okay, so let's look at some other charts here. What I want to talk about now is the playbook of the Fed, the government, the big banks. So in this chart, we have the effective federal funds rate. And in the gray lines, you have each recession. So this goes back to 1955. You can count 1, 2, 3, 4, 5, 6, 7, 8, 9 recessions. Okay, in each recession, you had a stock crash. And I also want to note what happened to the cost of money, the federal funds rate, the cost for really your JP Morgan to borrow money. Well, the Fed cut rates to 0 in every single example now, didn't they? And in every single example, almost without exception, the Fed was able to predict the stock market crash before it happened. That's interesting, isn't it? So they're literally cutting rates rapidly into the recession and during or before the crash, almost as if they had a magic globe telling them the future, right? Or is it that what they've done creates the stock market crash? Also, what happens every single time we have a recession? Well, the government issues a massive amount of debt. And here's the playbook, here's the strategy. The economy has a problem. There's big financial losses. In 2000, you can think of the dot-com bubble. And in 2008, it was the real estate crisis. In both these instances, the bankers lent money recklessly to people they should not have. Okay, and then rather than actually have to go bankrupt and lose money, what happened? Well, the government bailed them out in both examples. So when there is malinvestment in the economy and it's too great for a single bank to stomach, we have to use the government to bail out those problematic parts of the economy. And so the strategy is the government must raise the capital and bail out whichever part of the economy is struggling. So in 2008, it was the banks who lent out all this money for mortgages. In the dot-com bubble, it was a bunch of IPO madness, all these tech companies that were raising hundreds of millions of dollars. Was a lot back then. Now it's billions of dollars, but back then it was only hundreds of millions. And they weren't making profits. They're just wasting money, throwing parties. Very few companies came out of there profitable. And don't forget, in the dot-com crash, Amazon crashed 98%. And that was a great company before the crash, a great company after the crash. But just goes to show you, it's really not smart to pick a single company as a winner when you know the entire market's in trouble. And that's what I believe is the case currently. So this time around, there's just so many people being bailed out. It's endless. Real estate related markets are in severe problems. The unemployment rate is just at a massive high, much worse than 2008 or the dot-com era. In fact, you'd have to go back to the 30s, the Great Depression, to find unemployment at this level. So the first thing to realize is the economy suffering massive losses? Okay, and so quite clearly the answer to that is yes. Okay, so next we need to realize what the mechanism is to fix that. And the mechanism is to cut rates to 0 or significantly lower. and then for the banks to lend money to the government to go in and bail out everyone until the problem is resolved. So that's what's happening right now. We've had the government go make all these huge spending bills. Now they're going to fund it. They're going to take that money and give it to the weak parts of the economy that need the bailout. We're going to get everybody back to work. And then after that's all completed, then the Fed will come back in with quantitative easing, allowing the banks who lent the government money to get a huge payday. And then they can go turn around and buy stocks. And that causes the bottom in a stock market crash. So again, I don't think this time in history will be any different, and quite likely far worse than any crash we've seen in the last 4 decades. So you have to go way back in history to find something anywhere near this problematic in the economy. And so it's no wonder Buffett didn't buy the dip. He sold the bounce, the dead cat bounce, and he's loaded up on treasuries himself. Mike, go ahead. Let's go ahead and open the mic for Michael Seebeck, Ryan. And Mike, if you do have your audio, go ahead. I'll continue until, oh, there he is. Hey, Mike. Oh, there he
Jason?
is. Hey, Mike, how's it going?
Hey, it's just frustrating as hell working and trying to do multiple things at once. But I've been so distracted for several weeks now. I can't hardly listen and focus on all the great information you provide. The question I had about TLT, did you by chance respond to that question in the chat, or?
Let me double check. What was the question, just to be clear?
Well, in a nutshell, I purchased on my own a 5/15/2020 TLT call, the 170 strike, and I just wanted to hear your thoughts on that. You mentioned multiple times today that the huge treasury purchases are coming. I've been watching this very site you're showing right now. And there's, the issue date on 5/15 for the 30-year bonds is going to hit, plus all these hundreds of billions of dollars that's coming down the pike, in between. So what are your thoughts?
Yeah, I think we're going to probably hit a top in the stock market right around when this issuance begins flooding the market. There could be a short-term spike in yield, but that in itself will cause money to flow into these products. So yeah, I'll be willing to close out my upside hedges as we lead into this and then start to get aggressive on the TLT going into the next several months. So I think your 5/15 expiration is too short on the TLT in general.
In time frame? Yeah.
In the time frame, yep.
Yeah. All right. Well, we'll have to eat a little dust, little dirt, I guess.
The good news is, guys, the best money to be made is when markets make big moves, and they make big moves when you change the underlying fundamentals. The underlying fundamentals have changed dramatically. So highly confident if you do follow the plan, we're going to walk away very handsomely in 2020. Great question, Mike.
All right, thank you.
Oh, you're welcome. Okay, let me continue, Ryan, with some more content here, as I do want to get through the general set of content here. Our presentation gets bigger by the day, but there's nothing that's not critical here. So, okay, so again, when they're doing QE, it was something like taking money out of your right pocket and putting it in your left pocket, no real wealth creation to fund the government. So that's what's happened in April, and $2.5 trillion has been added to the Fed's balance sheet, half of which was allowing other big players to take some profits from their bond position. And the other half was used to get about $1 trillion to the Treasury immediately for some of these bills we've been passing. And really the urgency was to get the small business loans out, as well as to get money to people on food stamps got maxed out, and then also the stimulus checks. So a lot of really critical things were done, rushed, because it would have really been bad for the economy if that didn't happen. So I can understand why the Fed came in and picked up T-bills with QE early to support credit markets, half of which went to fund Treasury requirements in terms of, again, primarily funding the small business loans, the $1,200 stimulus checks, ramping up food stamps, things of that nature had to be done at a rapid pace. So that happened very quickly. And this was done by the Treasury pumping tons of money in these short-term debts, and the Fed picked up those debts. But we knew that they're not going to sit there and just roll these over every week. And these are being rolled over every single week. What they want to do is sell this debt outside of the United States to primarily other central banks at near 0% rates. So if we can go borrow $4 trillion at near 0% rates, that would be ideal for the US government. It would also be ideal for the people buying these debts because it'll make the value of bonds go up. So no one really cares about a 1% yield, much less if we go look at the yield curve. No one's going to go loan the US government
Hey everyone, it looks like Jason might have lost his internet, so I'm gonna call him real quick and see what's going on. All right, guys. Yeah, Jason lost internet, but it looks like it's coming back online, so we should be started up in a few minutes.
Okay, so sorry guys, we are having some Comcast issues here. Test 1, 2, 3, we're back.
Sounds good.
Okay, great. So still got 70 live. You guys are very patient, appreciate it. Okay, so let's jump back into where we're looking at. This is the one look at the yield curve. And I'm going to show you what's been happening in the yield curve in the last several months. So inverted yield curve, everybody's heard of that. This is a signal that you have a stock crash about 18 months out on average, between 6 to 18 months. Now this first inverted last year, early last year, and the Fed's been doing everything they could to straighten that out, primarily yield curve control with QE, and then also by cutting rates towards just slightly above zero. And so what's the effect? Well, it straightened out the yield curve, good. The front end got dropped towards zero, which they've been suppressing. Although in the last week, we've seen foreigners fighting over this debt, signaling the move is coming near. And the product we play, the 30-year Treasury, and now also the 20-year, starting in May, now that they've added that issuance back, has dropped. And so we saw a very large return in the TLT, being long this position ever since, well, since our program began, but especially being bullish on this since February, once we realized the world was going to have to copycat what China did in January, what South Korea did in February, what Europe was doing by March, and again, what the US did also in March, and that's locked down their economy, which is absolutely devastating to companies. So my expectation is, again, to watch this pummel lower and lower and potentially get near zero. These will have to go to negative rates, which is a big claim if you're into tracking the bond market. Here's what went against us in April. I literally put on our first puts right before they ramped up 2.5 trillion in QE. So that was unfortunate, but again, I do not anticipate this going any longer. And we'll see Friday how much they cut it down. This week was only 40 billion. You go back 3 weeks, you were sitting on 600 billion. So the relative quantitative easing has reduced by 95% in 3 weeks. And so that again is what drove market higher, has put pressure on treasuries. Pete has a question. Go ahead, Pete. You will have to unmute your mic.
Yeah, I'm sorry. I don't think I didn't think I had my hand up, but maybe I hit it by accident. I'm sorry.
Oh, no worries at all.
Okay.
Okay, let me continue. So if you wonder why the stock market went up, this is why. Let's just pull up that H41 release so you guys can see with your own eyes what's been happening. So if you type in H41, you can find this webpage. I look at this every Thursday at the close for you and report it on Friday. What's the Fed up to? And so let's just see what the Fed's been up to here. I prefer looking at the average change week over week. So there's that's an easy way to do it. So again, they will itemize in this format what they've purchased or what they've sold. And primarily they've been buying treasuries and mortgage-backed securities, which makes sense. Protecting credit, protecting banks. Okay, so $25 billion added March 5th, week over week. Go to March 12th, they jumped that up to 77 billion, was not enough. We went to March 19th, they added $240 billion. They're just getting started. Go to March 26th, they issued $506 billion in balance sheet growth. And again, mainly buying treasuries, but also mortgage-backed securities. April 2nd, we hit the high point, $605 billion. That's 0.6 of a trillion dollars in a week. Usually they use that much QE over the course of a year, not a week. So it just shows you the magnitude of the losses in our economy and these big players having to get bailed out. April 9th, this is when we started dramatically reducing QE, 393 billion. We go to April 16th, they cut that to $228 billion of quantitative easing. April 23rd, we actually had a small upprint, 255 billion. Last print was low, 146 billion. And I believe the print coming out tomorrow will be potentially below probably around $80 billion. So we'll see if you were to double it, maybe as low as 60 billion. So we're coming right into the moment in time where they're going to start flooding the market with long-term debt. So it's just really no coincidence that QE is coming to an end right before the Treasury is going to dump $1 trillion a month into the Treasury market. And that is really going to put chaos in the equity market because so much money is going to be flooded into those. So again, if we see the QE announcement Friday, so again, Thursday, we get to see what they've done in the previous week. And then on Friday, we get to see what their intentions are for the coming week. And the trend has been less and less and less. And then again, that is critical for the US government to fund its debts. We have to force people to buy and hold debt, not just get out whenever they want for a free profit from QE. So really old buyers of debt are getting to cash out some of those right now. And what comes next is forcing everyone to hold these debts. And again, we have $4 trillion to sell, 3 in the next quarter. This is massive. This is the most debt we've ever tried to sell in a small period of time. And what we've been predicting. Okay, so that's what's coming down the pipeline there. Instead of QE, they flip to repo. So repo is a loan where you can put mortgage-backed securities or treasuries as collateral and get dollars from the Fed. I anticipate this will be spiking as we put more and more pressure in the financial system trying to sell all this debt. So this is really nice for somebody like JP Morgan because it allows them to buy an unlimited amount of treasuries, hold those treasuries, which they know the outcome, which is, again, rates going lower and lower. It's been the trend for 4 decades. It's not going to stop when you're issuing $4 trillion in debt. And then once we've solved the problem in the economy, bail out everybody, get the economy back to work, probably going to need a vaccine to get out of this mess. Then they're going to come back in with the real QE. So I would tell you the QE we saw in April is nothing. but they're going to pull it off. They're going to stop doing that QE until this debt is issued, sold at long-term interest or long-term durations at low interest rates. And then again, redistribute the capital, fix the problem, and then wait to see the biggest amount of QE in history. And that's when we want to buy those ETFs and have returns of a lifetime owning equities. Not right now. Okay, so the April move was beautiful. We missed it. I apologize for that. I'm the guy who likes to watch this QE like a hawk, and I ignored it. I was gazed over by 30 million people coming unemployed. So that was my mistake. But now it's clear that the QE is coming to an end. And at this exact same time, they're about to push trillions of debt products into the market. So your opportunity for that move is over. Here's a look at a 100-year chart on the Dow. And again, you got to ask yourself, are we doing QE for deflation, which is 1929? Or are we going to be doing rate hikes for inflation, which is this period of time, 1965 through 1970? So if we were having inflationary problems, that would be really bad because we wouldn't be able to keep rates low, and we also wouldn't be able to do QE. So we would be in a bearish market overall for stocks and bonds. So that's what happened in 1965 through 1980. You had Paul Volcker come in there and jack interest rates ultra high, and that just crashes everything. Okay, so if that were the case, I would not be telling you to buy bonds if I really truly thought we had inflationary pressures. Instead, I anticipate something much more like 1929 where you have deflation. So think about it. If you thought that Airbnb folks had over leveraged themselves, bought way too many properties, overextended their credit, and that they were going to be forced to sell their properties because they can't make the mortgage payments, are you going to wait a year to buy a property, or are you going to buy it right now? Probably going to wait a year, right? So that's the basic idea with deflation. You have this belief set that if you wait, you can get a better price, and that puts the economy at a halt. So the Fed knows what to do with deflation, and that's cut rates super low and print lots of bonds. Okay. So that's what I think we have coming. That's the worst stock crash in history. And a 50% correction might be underestimating the quantity of a crash coming our way. I think what will really stop the crash will be a double whammy of QE plus the Fed actually buys stocks. And I believe we can go somewhere between the 2007 high and the 2009 low. So I think we're going to not go below that 2009 low, but that we will potentially breach this level right here. And that it will all come to an end when the Fed capitulates and literally buys stocks through the Treasury with a special vehicle instrument to do that, which again is, of course, not what their guidelines say they can do, but they're also doing this for with BlackRock to buy up junk bonds. So that's what I see coming down the pipeline here in the stock market. We're going to have to be really careful and precautious about when we buy into to these stocks. And again, be careful which companies we want to invest into. This is not something that's going to have healthy companies at the bottom. It's really just going to be a handful of sectors that I think will really outperform. And again, that's mainly the healthcare biotech. As evil as those pharmaceutical companies may be, it's quite clear where these trillions of dollars are headed. Okay, straight to those groups of companies. But again, even Amazon, which had great profits the whole time, the whole damn time, they lost 98% of their market cap in the dot-com crash. You go look at their profits and earnings. There's no big change from 1998 to 1999 to 2000, 2001 to 2002, just steady growth like a clock. And even their corporation had one of the, well, the single biggest drawdown in history for Amazon. Mark B says, or you've realized you don't need so much crap and you change your consumer viewpoint. So yeah, if you're worried about your income, you're going to start being quite careful with what you spend money on. Jack says, why would a foreign country want to buy the US Treasury? Well, they need dollars. So you can either just buy dollars or you can buy treasuries, which essentially are guaranteed for dollars. Plus, you get interest. And plus, if you understand what happens in the bond market when government explodes its debt, then you know you can sell it right back to that country for a huge profit when they do QE. So they all know this. It's been happening about every 10 years, like clockwork, for the last century. The exact same thing repeats itself. So the only thing different this time is it's probably 10 to 100 times worse than the last two crises you guys have lived through. And that's why we had to actually support the bond market with a shot of QE. We had to emergency print essentially $2.5 trillion, half of which went to basically central banks who were desperate for dollars. And the other half went to the Treasury, which they used for small business loans, and they used it for the stimulus checks. And that got eaten up quick, didn't it? Now they need more money and they're going to sell it, not in that T-bill, not with QE. They're going to really offload this to real buy and hold investors now. So we'll get further evidence of this Friday and the following Friday. And if I'm right, the Fed's going to continue to reduce the size of Treasury purchases, which again seems like the opposite. You think you want the Fed to buy treasuries to be long treasuries, but it's actually the opposite. If they're buying treasuries, we want to be long stocks. And if they're cutting interest rates and not buying treasuries, we want to be long bonds. So we'll show you proof of that. Let's see, in this chart, we're looking at the TLT ETF. This is just one hell of an asset. And that's because it's not reliant on corporations making money, consumers spending, things like that. What it really does rely on is governments wanting to grow their budgets. So these governments love growing their budgets, and when there's a crisis, they take advantage. And so rather than let people who were not prepared for this crisis go bankrupt and clean the economy out, no, we're going to bail out everybody. And because those same people control our government. So what did they do? They issued the most debt in history, and it's coming down the pipeline starting in May. So time to get excited for this strategy. Just look, every time we have a crisis, three things happen. Rates go to zero, stocks crash, bonds rally, and the government spends way too much money, right? So 2008, look at your TLT spike. Let's go for percent change. So 0 to 38% return, 2008 crisis. Okay, QE came in towards the end, letting everybody out, and those yields came back down, and you had a healthy stock market. So that's the same trend we want to play. 2015, China just about destabilized the world economy because they're just completely reckless, building cities the size of New York. They have at least a dozen. They had a good business model. Okay, so in 2008, they were by far the biggest returning stock market. They outperformed US by a factor of 4 to 1. And so they're making tons of money as a factory for the world. They had like 2 really good cities to do that. And their strategy was, you know what, if 2 works, let's go for 24. So they literally took all of China and massively overdeveloped it with skyscrapers, with expensive condos. There's tens of millions of condos that are not finished. There's a dozen cities the size of New York that were never completed. They had to abandon it because there's just not enough demand for all these cities, maybe for 3 or 4 or 5 or 6, but not for 12 or 24. And so they had the biggest real estate bubble and still have the biggest real estate bubble in all time. And it all almost came tumbling down in 2015. They saved it with a lot of debt for a temporary fix. Pushed their debt to GDP from 250 to 350%, totally unsustainable. And now you have every country in the world pulling out manufacturing and getting ready to punish China. This is going to be something for the history books coming up. But look, TLT went up in 2015 when China nearly collapsed. We can go to the recent crisis, and TLT is skyrocketing up. So again, we haven't raised the money, we haven't solved the problem, and we're just starting to sell the debt. So my anticipation is TLT is going to skyrocket much higher. This is the Jeffrey Gunlack slide. So yellow is Japan, black is America. If you go back to the 80s, Japan was just on a roll. They're going to be better than US, bigger GDP. Tokyo is worth more than all of California. Their stock market did great. Problem was governments take advantage of success. They issue lots of debt. Real estate prices go up, cost of labor goes up, corporations get out of Dodge, and now you're left over with overpriced real estate. You're just left with overpriced everything. And so Japan had a multi-decade crash in their stock market and never really rebounded after that. The next big run up was all about the euro during the dot-com. So dot-com did great in black. The European indexes did much better. And the big picture was Europe is going to be the ultimate power, combining all these different nations together. Too bad they couldn't get along. That didn't last, crashed, took decades to get back. Next big rally was all about China becoming the big superpower, building all these factory cities. And you can see that massive outperformance in emerging markets and in the Shanghai Composite, outperforming relative markets 3-1. Problem is they overdeveloped, and that came tumbling down, never recovered. This time around, the clear overperformer was the US market. Let's see, do we still have audio, Ryan? I just had a weird sound pop up.
Yeah, you're good.
Okay, great. So the thing that really troubles these economies is getting too leveraged in debt. It drags on companies. So we have the biggest run up in US history, outperforming all other markets. But what was it fueled by? Debt, 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 debt. Consumer is loaded to the ears with debt. The corporations are loaded to the ears with debt, and the US government is loaded to the brims with debt. And that, if that was bad in 2019, it's about to get much worse in 2020 through 2022. So the big prediction is these debts are going to be a drag on the economy for many years to come. So who will be the best performer after this? Time will tell. That's why we got to be careful about which stocks we want to buy. If I'm right and we do get this big crash, it's not going to be the entire S&P 500, not at first at least, not by a long shot. Here we're looking at the SPY against the TLT. Just again, you can just visually see that stock. Let's see, in the orange line we have the TLT. So look at this pullback in S&P 500. You get a rally in treasuries. I'll zoom out a bit and go to a monthly chart. And so it's just really important to understand that these have an inverse correlation, and that the TLT goes up when stocks crash. We've really covered that in great detail. Now I do want to point out the recent move is not natural. So to see the stock market rally and the bond market rally at the same time is highly conflicting. And again, that's because of the QE. I believe the bond market's correct and that the stock market's incorrect. And I think it's quite hard to develop an argument otherwise until we have our labor force back to work. Okay, so we're nowhere near that happening. Again, you're looking at this very awkward correlation. These two are supposed to behave in the exact opposite direction. So that just shows you how big this collapse was. And again, it's just beginning. In this chart, we're looking at LQD, investment grade bond fund. This has been fueling the corporate buybacks, which does great as long as you don't have mass liquidations. I do want to point out that in the 2008 crash, TLT went sky high and LQD crashed significantly. So although these assets do show a good deal of correlation, when there's a true crisis, the bond product you want to own is the treasury and not a corporate bond. Okay, so that's what I want to point out there. GDX is highly correlated to emerging markets. So I like this slide. A weak dollar is very good for emerging markets and for gold. We have a strong dollar, I'm afraid, despite $2.5 trillion of devaluation of the dollar. So again, I do expect GDX to sell off with the general stock market. That's why we have our puts. Great leading indicator is to look at very weak assets that are inflation. Okay, in this chart, we're looking at different yields on the treasury spectrum. We have the 30-year, 10-year, 2-year, and it's really important that this 2-year keeps going lower, as this has really been the leading indicator for where our product is headed. And we can see it is pointed down. As long as there's a spread here, I'll be betting that this yield is going to chase this yield. Now, in this chart, we're looking at competing bond markets. You got to realize something like 90% of the bond market is US debt. All the other markets are tiny. But the lower the competing markets, especially the German bond goes, which is negative, you have to pay Germans money to lend them money on the long end of their curve. Why would you do that? Not because you want to pay them money to lend them money, because you believe their economy is in trouble and they're going to have to raise lots of debt and drive these yields much more negative, which means you make money flipping the bond and not by holding the bond. And sorry guys, I'll get the audio fixed by the next webinar. Here's FXI. I would say that we could easily test the 2009 lows, especially with all the political chaos that will likely be put on China. But I really hope that American government actually delists this ETF. I think there's plenty of reason to do that, and that would get our maximum payout. We're at that 31 strike. So if we go anywhere near the 2009 low, we're looking at 1,000 to 5,000% return. If we can get this delisted, then you get that 30 to 1 return. That'd be the maximum payout on that FXI put. Expect to add a 2-year leap on this. So we'll look for a quick profit going into the election. And then hold the longer term put in case the real fireworks are saved for after the election. We also got to be prepared if Trump doesn't win, what would that mean? So that would certainly change our views on how to trade the markets. Copper to gold ratio is very indicative of where treasury yields are headed. And currently it's pointing straight down. So copper goes up when we're having a healthy economy and building things. Gold tends to go up when there's inflationary pressures. You take that ratio and you can predict the future price of yields quite accurately. And so this is indicating yields are going lower. We have looked at the yield curve. We've discussed the playbook of the Fed. Cut rates, raise money, solve the crisis, then do QE. It's a 1-2 punch. You make money on the bonds, loaning money to the government, then you make money exiting those bonds when they do QE, and you buy stocks. That's the playbook. They've done it just about every 10 years without failure, and successfully at that. Here's that massive emergency QE that they did early, which I am anticipating topping off and going flat until the debt has been raised, critical for our strategy. And Here is a look at long-term interest rates. I just want to warn people of what can happen if we get runaway inflation after all this is said and done. So let's let this chart update. Come back to that while it loads. Okay, Rick says I have the 170 call you suggest, and I have the underlying and a put. That's right, Rick. You are following it accurately. So the 170 call we have until January expiration. So that's a great position. But I'm getting more bullish by the moment. So do anticipate to sell our calls at some point and move those strikes up. The put option protects against downside risk. So if I buy, for example, the 161 put option expiring Friday, which is what we have right now, let's just say for fun, well, it wouldn't be fun, right? But let's say something bizarre happened and the TLT cratered to $100. Well, we paid something like 25 cents for that put option, 25 bucks. We would be sitting on a huge loss. But because we bought the put, you don't have to do anything. Don't sell your put. Don't do anything. Don't touch your TLT shares. If that put option is in the money, your broker will automatically give you the value of the strike and sell your TLT shares. So rather than potentially risking losing tens of thousands of dollars, you can buy a cheap $25 put option and not worry. You don't have to worry. So the put option allows us to get a guaranteed price for our TLT shares, no matter what happens at expiration. Can the TLT go to 100, jackass? It's possible, highly unlikely. That would mean the government's having everybody who holds bonds running for the exit. So it would mean we don't sell the $3 trillion deficit. We do not. If the TLT went to 100, the stock market would crash and your put options would pay off. That would be absolutely devastating. So it's really critical that not only do people buy and hold new bonds, that the current, I think it's 18 trillion outstanding in debt, we have to keep those people holding as well. So we need all the old bond holders to hold their position, and we need all the new buyers to hold their position. So we not only need the old, but the new to be buying and holding so that we can get this money to the government. So the only way this works is if yields go lower. If yields start to spike, you're going to be showing a loss on the bond, and you're going to be looking at more attractive yields that you don't get. So yeah, if the TLT were to crash, that would be devastating for the US government to fund its deficit and would create a stock crash in itself. Because you're not going to get this trillions of dollars to the economy to save the day. So yeah, there is a risk that yields can spike for a short period of time to reprice where banks like the yield at. I'm not going to argue that. But in the grand scheme of things, as the trillions of dollars are sold, the only way banks make money from this is if yields go lower, which means the TLT goes up. And there's just really no way around that. So the government's going to pay the interest rate in which it issues, okay? But then the lenders of this debt get to fight over the bond, and that's what's causing these yields to change outside of what the Treasury is going to have to pay. So the government would love to sell most of this debt at a 0% rate. So getting in early is critical here. The government is really incentivized to sell most of its debt at the lowest rate possible. The lenders want to lend the debt starting at the highest yield they can get away with, knowing that it must go lower. Otherwise, everybody's going to sell that debt. Rick wants to know why not buy more now? Yeah, Rick, I'm ready to ramp up our positioning on that. So just stay tuned. Right now, we have about the same capital at work as Warren Buffett in terms of the TLT position. So if you look at Buffett's portfolio, what does he have? He got rid of the airliners. He's got over half of his entire portfolio in treasuries, and he's hanging on to Apple. He's probably buying put options to hold that because he knows he could never rebuild that large position. He's super pro-American, so it would be un-American for him to go sell our national champion. So I bet you he's just loading up. The put to call ratio has been 2-to-1, by the way. So Buffett's probably just loading up on puts to protect the companies he wants to buy and hold for the rest of his life. And so he's holding a bunch of banks. JP Morgan is one of his biggest bank positions, and Wells Fargo. What do those guys hold? They hold debt products, mortgage-backed securities, and treasuries. In fact, JP Morgan's books almost all treasuries. So when you look at what's actually inside of his portfolio, it's highly, highly loaded up in these debt instruments. So yeah, Rick, we will be carefully adjusting our strategy to make the most sense and profit from this. But I do like our risk right now. I would never have you 100% in a single asset class. So right now we're above 50% when you add up the call options and the TLT position. So that's about the max I would ever risk for any reason under the sun on a single strategy. So we have another group of capital playing the other side of that play, which is shorting the stock market. And we have some hedges to the upside because we know timing's always the most difficult part in all of this. All right, we're gonna give up on that chart. It's not updating. All right, guys, we're gonna go ahead and close out today's presentation. I do have a lot more information to continue in tomorrow that we didn't cover today. So I do invite you back tomorrow and we can deep dive into some other asset classes that are part of our strategy. At this point, I'll take any last questions and let you guys go for the day. And we will continue the education and go over some new content that we did not cover today tomorrow. Don't forget, we also have the boot camp where I'll go into the Hong Kong trade in great detail, as that is by far the best return with the least risk that I see in the pipeline. Bill has his hand raised. Go ahead. We'll go ahead and unmute Bill now. C5502 says he loves the education. Well, I'd love to hear that. Thank you for the kind comment. Ed says, have you considered using spreads instead of selling puts when buying the reprised ETFs? So yeah, Ed, my strategy for entering those ETFs is going to be remaining long these critical put options, which we call the foundation of our trading plan, and then sell out of the money puts when the volatility is extremely high. So I think we can make anywhere from 5 to 10% a week when the volatility level is extremely high, just from selling puts. And then if those puts do go into the money, I'll be willing to buy and hold those positions. So we won't be over leveraging ourselves from that. The boot camp will be at 3 Eastern tomorrow. Tony, go ahead. No. From the admin says, should I sell to open? No, it said buy to open. Yeah, we don't. That'd be the opposite of what I've recommended. Tony, we have you unmuted on our end, but you do have to unmute your mic.
You got me?
Yes, sir. How's it going?
It's good. It's good. Been doing some stuff out here in San Antonio. Yeah, I did get on an airplane, left Colorado, came to San Antonio.
Yeah, how was that
Anyway.
experience? Was everybody wearing masks or?
Everybody was wearing masks. There are only 15 people over to Dallas, Fort Worth, and 20 here to San Antonio.
Yeah, I saw a headline. If you pay $39, they'll guarantee middle seats not filled.
Yeah, you get a row to yourself, so it's all right. Hey, listen, my question has to do with the U.S. dollar Hong Kong trade, the
Sure.
Forex.
Yep.
why would it continue to make sense to think that China, while having all of this disapproval, worldwide disapproval over their handling of the coronavirus situation, why would China further antagonize its people, especially Hong Kongites, by taking on such a move to move financing over to Shanghai?
Well, they don't want to. So yeah, Hong Kong has quickly become the single most expensive real estate market in the world, and that's because it was the financial center to really fund China. And so they have a government structure in Hong Kong that's much more attractive to investors relative to the Chinese government. So if you go over to China, it's illegal to audit its communist secrets. They think their whole strategy of how they operate their government is far superior than everyone else's, and so they want to keep it top secret. They don't want to reveal what's happening. So you have to trust their own data, which we all know is usually false. So yeah, they don't want to shut down Hong Kong. But Hong Kong's operating in a different set of laws that's supposed to be democratic and have a real legal structure so that investors can go have rights like you have in America. So yeah, they don't want this to happen. The question is, can they stop it from happening? And so Hong Kong is in a lot of trouble, and it will cost China a fortune to keep it really above water. So the bottom line is they printed 1.4 trillion Hong Kong dollars in terms of U.S. value, but they only have 400 billion in U.S. dollar reserves. So if everybody tried to exit the Hong Kong dollar at once, they just don't have enough money. So they'd have to turn to China, or they'd have to start liquidating assets. So everybody who's invested in Hong Kong real estate believes that the value of their real estate will never go down. They think it's going to appreciate by 10% a year indefinitely. So just go look at Japan for how that worked out. Now, meanwhile, we got to look at the balance sheet of the Chinese. So the Chinese have 3 trillion reserve, and that's down from 4 trillion. Meanwhile, they claim their currency is worth $30 trillion. So they have about 10 to 1 discrepancy in how much reserves they have. Now, there's a big difference in Hong Kong. It's supposed to be, again, much more like America, so you can freely trade the currency. You can take it out of the country as you like. And there's a legal structure that's far more similar to the US. So it's really conducive to raising capital in the market. So that's why most of their capital is raised through Hong Kong. But it's a weak point that the American government can attack. So there's a lot of factors. Bottom line is, China is going to have to support Hong Kong if it continues to weaken, and especially if we start putting disadvantages to raising capital in Hong Kong. So it's a big story that we can cover. I think we'll do quite a big review of that trade Thursday in the boot camp, because I know a lot of people have questions about it. But the bottom line is, China makes a decision that they don't want to lose $1 trillion reserve of their reserves. So they would have to lose in a snap potentially 33% of their total reserve just to bail out Hong Kong. And that's just for the currency. If their real estate market crashes, the Hong Kong stock market starts getting restrictions placed upon it. If we start requiring audits of these Chinese companies, there's a lot of things that the government's been talking about. Even last year, Mark Rubio has been one of those big proponents trying to punish China. So the writing's on the wall, and I do believe we're going to be putting a lot of pressure on Hong Kong. So yeah, that's bottom line. Now, what's beautiful about the trade is it has not budged. Let's pull up the pair. Looks like a big move right there, right? Huge move. Go to a weekly, go to a monthly view. So in the last 2 decades, at least we have it trading view, the biggest change of price is from, it was recently, and these are monthly candlesticks. The biggest move over a multi-year change was a move of 1.3%. So bottom line is it's going to cost $1,000 to put the mini contract on. You're going to want to put another $100 for overnight risk, and that's really way overboard. But another $100 so you don't get a margin call. And I'm telling you that that would cover you for a multi-year move, but that's what we're thinking about as a risk for not getting called out of the position overnight. Would be a 1% move. And then we're going to have to pay, the swap cost was 19 cents. It's gone up to 23 cents. So the swap cost is 23 cents a day to hold the position. There's just about zero risk this goes against us. And again, it's a big speculation that Hong Kong goes bust, but it's one where you don't risk losing much money. Your risk is not the underlying changing. It's really if the swap cost bugs you. So 19 cents a day per $1,000 you invest, but the $1,000 leveraged 10 to 1. So $1,000 position gives you $10,000 play here. So it's a beautiful setup. And again, if they just abandoned the Hong Kong dollar, and I'll pull up some of these 2-hour interviews with Kyle Bass where he goes through some of the history. Many times in history, when you try to take one currency that's highly correlated to China in this example, but you'd peg it to the US economy, it creates a tension that becomes economically unsustainable. So that's really the bet, is that Hong Kong cannot support the exchange of its currency. And as everything begins to deteriorate in Hong Kong, people are going to want to exchange out of the Hong Kong dollar into other currencies, and they're going to run out of money. So this simply could go to zero. And if that happened, the person who did the other side of the trade is probably going to get a margin call and lose a ton of money. And then our broker dealers now on the line. So I was really, that was my new concern, is if this did happen, well, the person on the other side of the trade is going to be having 100% loss very quickly. Now TD Ameritrade is going to actually have to pick up the tab. So this is our 100 to 1 returning trade. You can put 1% of your portfolio. You could put every spare penny into this that's not being invested, and your only cost is about 25 cents a day per mini contract. And it's just very little chance this goes against you. Now, I wouldn't say go put your whole portfolio on this. We're at 1% now. Second, we put some tariffs out, I'm going to jump this up to 2 or 3%. And yeah, the currency pegs break maybe once a century. If this currency peg breaks, you can double your net worth with 1% in here. So it's a beautiful setup. It's hard to lose money. The Hemingway quote really makes a lot of sense here. How did you go bankrupt? Slowly at first. So we can see Hong Kong slowly having the worst economic conditions in its history, and then all at once. And so this is not a trade where we can wait for it to move and then jump into it. This is one where it snaps and then you either were in it or you weren't. So again, this is a boot camp trade. I'll cover it in detail Thursday. And yeah, does that answer your questions, Tony? So yeah, it's a speculative play. Our boot camp is going to be where we put on these trades that require a big event to happen that hasn't happened yet, and we're trying to predict that and position for it.
Okay. That answers my question. I was just thinking of it wrongly. It's more of China's trying to save Hong Kong's ass, not punish them. So it's not a punitive action that they're taking.
Yeah, no, China does not want to lose Hong Kong. It's a beautiful, have you ever been to Hong Kong? I haven't.
No.
But when we go through the boot camp, we'll look at their whole setup. It's just this beautiful setup they have. They call it the Greater Bay. So they've got Macau's, I may be mispronouncing, Macau's basically Las Vegas. Shenzhen, which is bordering Hong Kong, is their tech, it's their Silicon Valley. And then their New York City is Hong Kong. So they call it the Greater Bay. It's beautiful. It's the most expensive property in the world. And a good lesson is to go dig up all those books about Japan and their crisis. Same thing's happening to Hong Kong right here. So yeah, this is a big move. This would probably be caused by political ramifications of the U.S. government starting to take actions against China and target Hong Kong as a weak point that we can easily attack. So I'd expect FXI to hit a profit before this one did. But FXI, we can, look for Ethereum to crash and be like, okay, the big guys are starting to sell. We can wait for tariffs to be announced and jump on that, if you're wanting to wait. This one, it could happen overnight, and it's not going to be a trend you can watch and jump into. So that's why I've been sitting on this trade for a year. We finally put in a 1% position. Karen says it's pronounced Macau. Thank you. Jack says, is it likely China will move to Hang Seng or Shanghai? Well, they've already put a financial center in Shanghai, and Jim Rogers is quite an expert on China. He moved to Singapore long ago, and so he's predicting, well before all this, that they would ditch Hong Kong because it's not necessary, it's too expensive, and move it to Shanghai. But regardless, the point is that they're not going to support Hong Kong, and their economy is extremely over leveraged from real estate to their currency, and it can easily be a target of political attack. And meanwhile, you got those people in Hong Kong are pissed. Their cost of living has skyrocketed while their income has only marginally increased. At the same time, China's throwing anybody who's a political activist pro-democracy into jail. They're cracking their arms in half right on video camera in the middle of the streets. They're shooting these people, and they're trying to get new laws passed that they can seize your bank account in Hong Kong. They can drag you out of Hong Kong to China for prosecution. So I'm sure the government in the US has been helping incite all these protests without doubt. And so, yeah, Hong Kong is a mess. We've been watching it carefully for a good year before pulling the trigger on this. So we're not just rushing into this. I do think it does make sense to have that position right now. Saras, please go ahead. And thank you, Karen. Hope you're having a good day. Let's get Karen's 2 cents too. Let's wrap up with Saras and Karen, and we'll call it a day. We always want to hear Karen's feelings on the market. She's been pretty good at predicting some contrarian viewpoints before they've happened, especially the trade deal being a bunch of baloney, didn't you? Hey, Karen.
Hey, yeah, I had to jump off for about an hour and a half. I'm sorry, I've missed a bunch. I know I'll have to go back and review. It's just been, Wednesdays are crazy. That's my shopping day and Mother Day. So a little drama.
No worries.
Yeah, but yeah, I'm glad you wrote out all that info about TLT. I'm going to go back and review that again because I look at that. And of course, the first time I realized that my order didn't go through, I guess I didn't put market down for my my put on the TLT. It goes down, of course. So that's I'm anxious for that to recover and do well as you predict.
It's coming. Yeah, we're set.
Oh man, I'll tell you, not too soon. My patience is starting to run out, so I'm glad to see that. That what you're saying on that, because yeah, I've been watching that. I thought, God, what is going on here? What are they doing? But anyway, I have another question real quick on the Hong Kong thing because because I've had to do a lot of shifting of stuff around recently myself personally because of all this downturn and blah 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 personal stuff. I won't even bother telling you right now, but I haven't put it on yet. I'm trying to figure this out. Girlfriend of mine said to me, Karen, why don't you use, what does she use? CTG. Are you familiar with that company to do Forex? I know I shouldn't do this today. I should do it on Thursday, but I don't know if you ever looked into them. She just thinks the world of this people and I don't know. So I just didn't. I said, well, I'm going to find out. I know who knows everything. I'm going to ask Jason.
Well, just remember, if this trade pays out, most
Right.
likely the counterparty will be hitting a margin call. Now you're going to be hoping that the financial solvency of the institution you're trading with
Mhm.
can pay you out that 100 to 1. And so
Okay.
I would rather put my eggs on TD Ameritrade
Okay.
versus some, whoever.
Yeah, I don't know. They've been around for a long time, and I guess that's one of their focuses. But I guess their futures and forex, I don't know. But
Yeah,
I started looking into it, but not enough, and I figured I'd ask you first before I even waste my time. Okay.
sure. But yeah. So Forex is weird. It's not like the futures market where there's a centralized clearinghouse and
Uh-huh.
there's guarantees. The Forex market is a bunch of little mini markets, kind of like a bunch of little, I don't know, farmers markets. And so people can go arbitrage from one market to another, but it's not a centralized system like the futures market. So yeah, I'd make sure, especially with the Hong Kong trade, that whoever is the broker is extremely financially solvent to pay us out here.
Okay. Gotcha. As
Because
far as
whoever's the other person on the other side of the trade, if they're using the same margin we are, literally only takes a 10% move for them to be completely wiped out. And if
Mhm.
we're expecting a 99% move, they're wiped out in seconds. And now TD Ameritrade's on the line to cover the rest of that loss.
Okay.
And so, yeah, this could be really bad for people who don't understand the risk in this. Now, a lot of people think it will never happen.
Okay.
So I wouldn't put all our money in there and miss out on other opportunities.
Right. I hesitated because I needed to figure out a few of my other situations, and then I also was hearing that people were having a really tough time getting, not just here in your group, but some other people I know, they were just having a really tough time getting things going at different brokers because everything was such a disaster for a couple of weeks. So I thought, you know what, maybe I need to let everything calm down, and then I will, I'll do this and get it back in there, and hopefully I don't miss out. So, all right, I will get on it.
We can hear the war drum starting to lightly tap, so I would not delay on that one.
Yeah, I feel the same. I do. I feel that. As far as airline stuff, I got
Will
a
you answer my question now?
Yes, Ross, let me let Karen finish, and then you're next, then Kathy C,
Okay.
and then Tony, okay? Sorry.
No, that's
Okay,
fine. I'm done. Thank you very much.
Oh, okay, well, we'll chat more tomorrow, Karen. We got the double
Agreed.
header.
Thank you.
Thanks for chiming in, Karen. Always a pleasure. So
Um,
Ross, please go ahead.
Yeah, I have short the VXX for next Friday, which is the 8th. And so far it look okay. I don't know what I should be doing. I know it's trading at 1 cent right now. And I did it also for the 15th of this month, which is trading at 4 cents. So should I leave it in there or just?
Yeah, we'll be looking to sell the May 8th VXX put. If it shows value, we'll sell it. That was a short-term play betting Amazon would pump the market. Amazon failed, so we didn't get the payout on that one. Now, if people joining in later may be hitting nice returns on those, but there's still some QE in the system, so I'm expecting to trade range bound, which is very good for volatility to drop. So expect to start selling those VIX puts next week, and as depending on the amount of QE, we'll time those. So stay tuned. Right
So
now, no
so
change on those.
So the ones for Friday coming, I should just sell it tomorrow or today?
Wait for the trade alert that says to sell it. Okay, I'll always tell you what I'm doing in my portfolio, and so
Okay.
if I'm not doing it, then unless you have an insight that I don't have, then probably you should not
Well,
do it as well. Good
I'm
question.
not too sure. I'm not too sure how I stand. But I don't know what I'm doing really. I'm just listening to you guys and learning from you. Really, I said I short them. I short it, and it's there. They're all sitting in the account right now. So both of them, one for tomorrow, one for Friday, and one for the 15th.
Yep. Join us tomorrow, and we'll make sure you know what to do with those positions. Right now, no action. Okay.
Thank you. I'll join you tomorrow.
Very
Thank you,
good.
Jason.
Good question. Thank you. Kathy. And then we got Tony next. Kathy, your mic.
Unmute.
Oh, there you
I
go.
was having a hard time finding unmute. This is just to encourage Karen. I opened up my TD Ameritrade over a week and a half ago, and at that time I asked for Forex trading. And as of yesterday, I didn't have it, so I started pushing again. So they're way behind. And I've been told I'll probably hear the answer by the end of today, early tomorrow. So I can't even move my money into the account yet.
Yep, good point. Very good point. So luckily, we've been giving people heads up, so you have had time to get that rolling. And I don't think they're gonna be pulling all the hot guns out at once. So I think we'll start off with some tariffs, and then we'll start doing some capital restrictions, and it's just going to continue to escalate and escalate. Oscar, oh wait, let's do Tony and then Oscar. And I saw the link you sent me, Oscar. I'll check that out. There's a lot of interesting info coming in that that topic as well. Tony.
Yeah, so TD Ameritrade sent my brother Eric. I don't know. Eric might want to pipe in and tell us which Forex trades they're not honoring anymore. And they sent out a message.
Yes, I did get that message.
Okay, so we were contemplating, what if they do that with a Hong Kong trade?
Yeah, I don't think that's an issue, but I'll make sure to be on top. I was aware of that announcement, and if there's anything that would be concerning, I'll definitely. This is one of our core trades, so I'll be on top of that. But this is a key. This is a critical. This is one of the main currency pairs in the world. The ones they delisted were very exotic pairs, and not a key currency pair in the world.
Yeah, that's what I thought, but yeah.
Yeah, good question. But yeah, if they did remove it, we'd want to go find a new Forex broker who's very well capitalized to take the trade. And interesting, Oscar pointed out, who's about to ask a question or give us a comment, that some brokers are requiring full margin on this trade. And now you can understand why. Because if I do the Hong Kong trade in Ameritrade and use the 10-to-1 leverage, and I'm right and the other party's wrong, well, it only takes about a 7.5% move before they get a margin call at the 25% risk. And now Ameritrade has to take over the trade. If we did the same trade at Interactive Brokers, we would have to put up the full 10,000 in margin. So Interactive Brokers, if this trade plays out, would lose much less than Ameritrade would. Now, the catch there is if Ameritrade could find someone else to take the other side of the trade, then of course they could push that off on someone else. But good point, good question. Oscar, how's it going?
How are you?
I'm doing good. What's the news on the ground? Oscar, just so everybody knows, is a administrator for many hospitals, especially in Florida, and has been providing a lot of good intelligence to our group.
Not anything specific other than I think there's been a bit more of a trickle of patients in the last couple of days. I don't know how representative that is of us freeing up everything this past weekend, but time will tell.
What about with children?
Haven't seen any children other than the one early on that I told you about.
Okay, that's good.
But other than that, that's very concerning, by the way. But
that New York report, yeah, that's not good.
It's very concerning. Well, because of the other issue that they're identifying with children too.
Mm-hmm. What about testing capacity? Are you guys still having trouble getting everyone tested you want, or?
Here's what we're looking at, Jason. Patients will be in four different categories. Those that have the symptoms and have tested positive, those that have no symptoms and have tested positive, those that have symptoms and haven't been tested, and those that neither. And those about 30% end up being with, with the issue, to not make mention of it by name. So basically, what we are doing, we are treating every patient like they have it. So it's not really making a difference when it comes to the facilities. We are going to be identifying treating every patient like they have it. And from a testing perspective, I don't know, we're getting our hands on more every day, but it's still not significant.
Yeah, it's not massive testing being employed, is it?
No, and like you said, I'm not sure we'll ever get over that hump where we can test everyone. It's not a pleasant test, by the way.
Oh, the one where they go 6 feet into your nose?
Yeah.
Oh man.
It's not a pleasant test.
What about the like a spit test? Is that something you've been hearing about, or?
We hear about it, but we don't really know how reliable these things are yet. All of them have a very high rate of failure, so to speak. So,
yeah.
How do you manage that? That you're testing someone and it comes back negative, and you really don't know.
Yeah.
Or they come back positive and you really don't know. I mean, if they show symptoms, that's easy. So it's gonna be a rough go, like you're saying. It's gonna be a rough go. It ain't coming, it ain't going away anytime soon.
Yeah, unfortunately, and Florida's starting to get pretty restless too, right?
Oh yeah, yeah.
Yeah.
Miami Beach got they closed down one of the parks because people just flocked in and weren't the necessary distances, and it was crazy. But
I wanna pull up my modeling here and get your input on it so far. This is a work in progress always, but I realize you're working with the data you have, and so we know 50% at risk of being infected. I think's undershooting that. Of the people who are infected that actually come to the hospital to get tested and complaining about it, right now we're estimating that 9 out of 10 people who catch this don't care, don't know they have it, beat it on their own, and never show up in our data. Okay, so of the people who are inclined to come to the hospital and come into your frame of reference, what percentage of that are you saying is being needing some pretty serious healthcare? I have it at 2 out of 10. So this would show up as 2 out of 10 folks who are coming to your doorstep or to this, to one of these testing facilities, is ending up needing to spend some time in a hospital.
Yeah, and you got to put that with an asterisk because a lot of these folks have comorbidities that they were going to end up here regardless. However, I will say that the typical patient, and it's hard to stratify that, but we're seeing less and less lose the oxygen or require the ventilators, only because now the doctors are a little bit more attuned to provide the hydroxychloroquine and some of the other antibiotic.
Oh, so they are using the hydroxychloroquine, huh?
Oh yeah, that's been used quite a bit.
Okay.
That's been quite a bit. And the antibody plasma therapy has been used quite a bit.
Oh, nice. Okay, now
in fact, I think I told you we had a fairly young man that was on a vent for about 30 days, and once they administered the plasma therapy, within 2 days, he was discharged from the hospital.
Let me ask you this. When did you start discharging people that are surviving? How much of a time lag do we have since people have been, I'm curious how many people are coming back sick that have been discharged previously and what
I
kind of,
haven't seen that yet.
okay,
I haven't seen those statistics yet. Let's put it that way.
okay.
But it's not significant by any stretch because we would have known about it by now.
Okay, now, so if we have 100 people come to your hospital and they are tested positive, how many of those folks are going to end up in a pretty severe condition, would you estimate? I have this estimate at 20%, 2 out of 10 end up in a pretty bad situation.
Yeah, but like I said, it's hard for me to quantify that because it just depends where they're coming from. If I get a nursing home patient, yeah, they're probably going to end up in a serious condition.
So, but in aggregate, regardless of comorbidities and all that, you would say,
I would say 15 to 20%, maybe even as high as 25%.
okay. And of those who end up in that critical condition, what's the save rate or the death rate? Do you estimate?
The ones that are ending up in critical condition, the save rate's probably closer to 80-85% now.
Oh, so this is much. So so we're saving people now at a much greater rate.
No doubt. No
That's
doubt.
good news. That's great news.
No.
And what would you put to that? Being able to identify it early on and then pushing hydroxychloroquine, or?
Yeah, the physicians are being much more aggressive with the prescription of the hydrochloroquine, and now they have a couple other bullets in their chamber that they're getting success with. So, but they're all very cautious. They're all very cautious because they don't know if this is a long-term solution or not, or as a therapy.
Any idea what percentage of those that are being tested positive are being recommended hydroxychloroquine? Is it across the board, or?
No, it varies dramatically.
Okay.
It varies dramatically. It just depends on the patient, how early they think they caught it.
So one thing I do want to point out is, which I've noticed, is the data can get a little tricky. So we know that the weaker immune systems, those with high blood pressure, bad cardiovascular systems, older, lower immune system, all that good jazz, they're the first to show weakness, right? So we come in and we have this super high death rate, and it's all older people. But then as time progresses, the healthier group of audience starts to come in, who has a higher chance of beating it without anything. So I think it's important to realize that, maybe right now we've already pushed through the weakest people where you had the 90% in this figure. But now perhaps you have a higher percentage of healthier people coming through your hospital doors, which would make sense. And so now you're telling me that 20% are only dying. But I'd be careful with that just because we know the first wave was older, and now I'm going to expect that you're going to see younger and younger people coming through the doors with this. Does that seem to be a trend? Yeah.
Without getting into specifics, I had a cardiologist just pass away in his mid-40s. Very, very, very healthy young man.
Oh, man.
Marathon runner.
Holy crap.
Just a very healthy individual. His father was a physician, and I mean, just a complete surprise when I heard the news, and it's sad, but you just got to realize not to let your guard down here.
Wow, marathon run. I thought my 2 miles a day was going to keep me out of trouble.
No, he was religious about it, and he and I became kind of friends because.
What was was it a heart attack? Was it?
No, it was the COVID.
Well, sure, but what was actually
asphyxiation?
Which organs were failing for him?
Lungs.
The lungs directly?
Yep.
Okay. Oh God.
Yep. And it happened very quickly. Very
Like,
quickly. So,
so
you know,
like a week or
and
two
you know,
after.
unless you do an autopsy, you have no idea
Hmm.
what the details are, but there was no doubt that, you know, the COVID did him in. Was there something else it caught onto, or did he have an issue that we didn't know about? It's possible.
Did they try the remdesivir?
No, it progressed very fast.
Just
I'm
no
sure
time.
I haven't had any chance to look at anything, and I'm not going to, but
Sure. Too specific.
yeah. But I imagine they tried everything.
Yeah. Oh man. Now,
And that
has your entire staff been tested?
everyone that has been suspected has been tested.
Ah, see,
Because
this is the big problem we face is we can't even, they should be testing everybody in the whole hospital probably every week.
you would think, but that doesn't assure you of anything. Of At this point in time, you know, if you show the slightest symptom, is when you will be sequestered and then ultimately tested. You
And
can't even come back unless you get tested.
some interesting data that shocked me was, can't remember, I think this was in perhaps Italy. Um, this fellow is a nurse fellow who has quite a good YouTube channel. But he was showing data that indicated only a third of the patients showed a temperature. Are you guys seeing that less than half of the confirmed cases are having a fever?
Well, in Italy, the issue was they were giving them the fever reducers
Oh, acetaminophen, yeah.
and hiding the fevers. And we have strict guidelines here that, you know, people are not to do that. Let nature take its course. That's your great internal thermostat that will fight any infection.
Yeah, so I'd be curious if you were able to get access to any data onto fevers, what percentage of the people you have fevers. That'd be very interesting because every report I've seen, I've never seen a report that 100%, never seen a report on any study indicating more than half the folks had a fever. So that's concerning when you're going to use these temperature strategies to try to identify folks, and we know that that may not be accurate.
Yeah, the staff gets screened every time they come in, and the PPE gets changed obviously a lot more. But you know, if there's drastic change or there's any kind of a symptom, sore throat or something like that, then they get put in a different pool and ultimately sequestered for a week or so. And if no symptoms show up, they get a test, and if it's negative, come on back.
Mark says our staff are being temperature tested every day. They stopped about a week ago. Interesting. What else do you have for us, Oscar?
That's it. That's it.
Oh man. Well, thank you for sharing these details every day with us. We really appreciate it.
Want to give Karen a heads up. It took about a week to get the Forex trading at Thinkorswim.
Okay, yeah. And Oscar's the one who initially went to Interactive Brokers, and now we know why they're smart and not doing the margin because they realize how risky this is to be the counterparty.
Yes.
Yeah, I started thinking about this. I was like, well, wait, if this, this is not something where they can really do a margin call and really protect the broker dealer, because if this were to snap in a sudden change, they wouldn't be able to. It just happened too fast, and just a 10% move would wipe out their position at a 10-to-1 leverage. So yeah, I would recommend with Hong Kong trade, make sure whoever is your broker dealer is very well capitalized. The more capitalized, the better. Okay. All right, guys. We went for 3.5 hours. We'll go ahead and call it today. I do appreciate everybody. Bring your questions tomorrow. I have a whole slide deck we didn't even touch today. Boot camp. If we need to, we'll spend the whole time reviewing the Hong Kong trade. That seems to be a hot topic. Although I do have some more slides coming in, similar to the Jeffrey Gunlack quarterly webcast presentation that I wanted to give you guys too. So see what we have time for tomorrow with the boot camp. Tomorrow we'll also cover oil market trades, gold market, which we didn't get to touch upon, and we can deep dive into the treasury market even more. Okay, Ryan, thank you guys so much. Let's go ahead and wrap this one up, and we'll see you guys back tomorrow.